It's okay, is it?
Thank you.
Okay, great.
I don't need to do anything more, do I?
Sawadika, and good morning, distinguished guests, ladies and gentlemen. On behalf of the Bank of Thailand and the Bank for International Settlements, allow me to welcome you all to Thailand. And thank you very much for joining the BOT-ASIA's Anniversary BOT-BIS conference on central banking amidst shifting ground. Ladies and gentlemen, the conference is a part of the BOT-ASIA's anniversary event, which aims to provide an opportunity for discussion and the exchange of opinions among the central bank governors, academics, and the private sector on issues affecting current monetary policy, as well as guidelines for dealing with future challenges. And for me, ladies and gentlemen, it's certainly a distinct honor and privilege to be a part of and serve you as a master of ceremony of this event. Before we move on, may I ask you to please turn off your mobile phone or switch it to the silent mode while the conference is proceeding. Thank you very much for your kind cooperation. Ladies and gentlemen, it is now about time. I would like to invite Mr. Sethaput Suthiwat Naruput, the Governor of the Bank of Thailand, to kindly deliver his welcoming remarks.
Fellow governors, distinguished participants, honored guests, it is a great honor and privilege to welcome you all here today. And many thanks to you for those of you who are attending here, of the journey that you had to, and the time that it took for you to get here. And for those of you joining virtually, thank you very much for again making the time to join us today. And a particularly special thanks to Augustine and our friends at the BIS for kindly co-hosting this event. We understand that without you, we would not be able to have assembled such a distinguished group of participants as we have today. This is a special time for us. Next week or so, on December 10th, is our official birthday, and we will be celebrating our 80th anniversary. And I can't think of a better way to mark and celebrate this important milestone than to have such a distinguished and eminent group of people discussing issues that are of direct relevance to us. So on behalf of all of us at the Bank of Thailand, thank you very much for this wonderful birthday present that you have given us. The topic of today's conference is central banking amidst shifting ground. And to set the stage, if I may, please allow me to offer a few remarks by way of context about the kinds of changes and the kinds of shifts that we see coming. I can think of at least three. The first shift is the rapidly changing economic backdrop that we face. In a nutshell, the economic backdrop is changing from one of insufficient demand to one of insufficient supply. And the clearest manifestation of that is what we see on the inflation front, where inflation has spiked. Global aggregate demand recovered and bounced back much more rapidly than anticipated from COVID. The rotation of demand from services to goods occurred very rapidly, and the supply chains weren't able to respond as rapidly as we had expected, causing a spike in prices, exacerbated again by the commodity price increases caused by the war in Ukraine. So supply constraints have come front and center, assumed center stage. And there are grounds for thinking that this is not likely to be something that is necessarily temporary. A lot of the stuff that we see is not just cyclical, but there are also secular factors which would argue that supply considerations are likely to be at the forefront for quite some time to come. If you look, the kind of factors, things like globalization, demographics, which were previously tailwinds, supply tailwinds, are now becoming supply headwinds and are likely to lead to price pressures going forward. So the context and backdrop is quite different. The challenges that are facing us as central bankers and the constraints are very different. We're moving again from a world where we had low inflation and we're concerned about zero lower bounds, but now it's a completely different story. We're in a world of high inflation, and the concern now is how the tools that we have, how can those affect things on the supply side. The second shift has to do with the conceptual and analytical frameworks that we use. Increasingly, some of the facts on the ground are contradicting what we might expect from our models. An example of that is what we see again on the inflation front, where things that we used to think were true, flat Phillips curve, doesn't look so flat, causing us again to underestimate and undershoot in terms of our inflation predictions, and suggesting a need that we need a better model and a better way of understanding the inflation process and how to model it, a better way of understanding how relative price changes can transmit to broader and more persistent changes in terms of inflation, how they can lead to inflation dynamics which might be self-reinforcing, a better understanding how inflation expectations are formed, and also understanding what is it that really drives pass-throughs. Another example of this changing conceptual framework, analytical framework that we face is on the financial regulation front. And here, the rapid digitalization of trade and finances has caused the nature of financial services that are being delivered to change. The types of entities that are delivering those services are also different. Where they're located is now different. So the boundaries and the borders are being eroded, and that leads to possible gaps in the regulatory perimeters that we use to regulate in this space, and raises questions about how do we properly strike, again, the balance, how do we strike the proper balance between innovation on the one hand and ensuring financial stability. What's the right balance to strike between entity-based regulation and activity-based regulation? And how do we ensure adequate competition and contestability in a situation where data and the underlying technology leads to this natural tendency towards natural monopolies and less competition? The third shift is on climate change and the response of central banks to addressing the challenges that are associated with climate change. Of the three challenges, this is probably the most daunting one. It's new to us. There are no precedents. And there are limits in terms of the tools that we have. The toolkit that we have is probably not fit to purpose. But yet, it's an area that is just simply too important to ignore. It's existential. And our response probably needs to go beyond just thinking about the effect of the green transition on inflation or the effect of physical and transition risks on financial stability, and think more actively about what steps we can take to try to influence the willingness of society to address issues related to climate change. The channel, which is likely to be the most impactful one, is through the financial system. So thinking through, again, the kind of incentives, mindset, expertise, and how we harness the creativity in the financial sector in a way that it's geared more towards ensuring that the resources that are available to finance the transition go to where they should go. Central to this is greater collaboration, both among domestic agencies and also internationally, to make sure that the initiatives that are being put forth by the NGFS and other international agencies are carried through. Distinguished participants, Mervyn King, the former Bank of England governor, once said that central banking should be boring. That may have been true some day in the past. It may once again be true, but today it is not true. The challenges that we face are not straightforward. The answers to the questions that we have to address are not obvious. But they will require us to have a steady hand, being able to separate out the signal of what we should respond to from the noise of the rapidly changing circumstances, and understanding, when we should respond and when we should not respond. It will require a sense of humility, knowing that a lot of things that we face are new and that we don't necessarily have good answers to all of it, and that we need to adapt to new situations and new information, and probably requires us to reach out more to stakeholders, given that not all the answers are things that we have, and not all the challenges are things that we have previously are familiar with or dealt with. But they also require us to stay very focused, first and foremost, on making sure that we achieve our core mandates and try to avoid the temptation to overreach, being realistic about what we can accomplish, and at trying to be sure that we don't try to address goals for which we don't have adequate tools, because doing so, we would risk undermining our credibility. Distinguished guests, I look forward very much to hearing your insights, and thank you all once again for being part of this conference.
Thank you very much, Governor Setaput, for the remarks. Ladies and gentlemen, without further ado, let's proceed to the first panel discussion on growth and inflation dynamics. I would like to invite the chair of this session, lead-off speakers, and all panelists onto the stage. Ladies and gentlemen, please join me to welcome Mr. Agustin Carstens, the General Manager of the Bank for International Settlements, to share the session. I would also like to welcome Mr. Yi Gang, the Governor of People's Bank of China, who joins us virtually, and Ms. Christine Lagarde, the President of the European Central Bank, to lead off this topic. Ladies and gentlemen, please let me introduce all panelists in this session. Mr. Philip Lowe, the Governor of the Reserve Bank of Australia. Mr. Peri Warjio, the Governor of the Bank Indonesia. And lastly, Mr. Raghuram Rajan, Professor of Finance from Booth School of Business, the University of Chicago, who joins us virtually. Mr. Carstens, the floor is yours.
Well, thank you. Well, colleagues, ladies and gentlemen, certainly for me it's a real pleasure to be here in Thailand. In general, to be here in Asia. I haven't been here for the last 2.5 to 3 years. So it's a real pleasure to be back, and definitely it's a real pleasure to have this taste of normality, and hopefully this will continue for years to come. As a very appropriately Setaput put it in his introductory remarks, for us central bankers, it has been a very interesting period, challenging period, and in a way the type of period that we hope will not arrive, but at the same time, when it arrives, it shows the great benefits that central bank can bring to society. And precisely that's what we will discuss today in different ways or forms. In this very initial panel, we'll discuss issues related to dynamics of growth and inflation, which are very broad terms, but at the end of the day, that's what the people really care the most about. How much are they going to pay for their sustenance? How is their well-being? And that's directly related to growth and inflation. Now, it definitely, before we go into the substance, I want to again thank Setaput for having put this together, for inviting us to co-chair this event with Bank of Thailand. It's a real pleasure to do that. Bank of Thailand has been a very strong partner of the BIS for the last at least 2 decades, and we not only cherish a lot the partnership we have had, but in the international community, the contribution of Bank of Thailand has been very important, and we're very happy to have been invited to this birthday party, as you put it. Just for procedure, I understand that this session is on the record and will be live streamed. We have a stellar group of panelists. You know all of them. It is particularly great to have here Christine Lagarde that came from very far away and just arrived this morning. So it's double privilege to have her here today. So before I start giving the floor to the panelists, let me just complement a little bit of what Setaput said in his introductory remarks, and let me take the liberty to share some thoughts on the topic to help set the stage. Well, needless to say, the return of inflation has been the defining economic event this year. At the same time, this has bring central bank reactions. This has bring reactions of society. And so we see now very different issues that characterize the economic environment. Rapid rising interest rates, tightening financial conditions, sharp asset price falls, financial market disruptions, even a meltdown in the crypto markets, and a material slowdown in global growth prospects. But at the end of the day, all this can be tracked down to higher inflation. Therefore, this is definitely the key assignment for all of us, and it's how to bring inflation down. Now, one aspect that is particularly important at this stage to realize, and I think this is different to other inflationary episodes, and that is that this higher inflation is essentially a global phenomenon. We have had in our own countries our different episodes of inflation. We have managed to tackle those episodes, but we have, I would say, never faced such an important increase in global inflation. The simultaneity of it is quite remarkable. I would say that over 90% of advanced economies have an inflation rate above 5%, and pretty much the same percentage as emerging market economies. So I think that is quite notorious. At the same time, there are very important differences regionally, and I think the richness of our panel here today will help us probably dwell deeper on the different inflationary aspects regionally. To start with, Europe is experiencing very high inflation rates, running now at 10%. Very good news this week. Hopefully they will continue. But I would say a salient issue is that high energy prices have been particularly acute in Europe, contributing more to inflation there than in other regions. In the US, inflation is high, but not as high, around 8%. Their energy and food prices have been less important, and I would say the contribution of rising services prices, particularly for housing-related items, have been larger, and they're clearly the aspect of aggregate demand stimuli associated with COVID has been playing a very important role, both monetarily and fiscally. In the region I come from, Latin America, we also have been having quite high inflation rates, but not that different from advanced economies, and that is also a quite unique circumstance. I would say the experience that Latin America has had has been very important and has allowed us a prompt reaction and bring inflation threats under control. And then we can come here to Asia, where also the story is quite varied. The two regional largest economies, China and Japan, underlying inflation is higher than usual, but it still remains quite low. And elsewhere in Asia, headline inflation sits in a narrow range between 5 and 8%. So I think it would be very important to highlight what are the differences, but at the same time how the collective reaction to this global inflation will help in the process of bringing inflation under control. And there are other aspects that also need to be highlighted in this process of simultaneous tightening, which is the spillover effects and the challenges that might bring in financial markets, namely how capital flows and exchange rates will adjust and what are the financial stability risks. Now, unavoidably, we know very well that sorry. Yeah, okay, fine. Unavoidably, I don't know what the problem is. Hello, hello? Hello, hello?
Okay, it's good.
Okay.
It's good.
Now, unavoidably, the tightening of monetary conditions will bring lower economic growth. Now, obviously, this will manifest itself in different ways. It is always an uncomfortable topic for central banks to talk about growth because we really mind it, we really care about it, but at the same time, we don't have much control about it, and oftentimes our actions are being evaluated based on the impact of our actions in economic growth. In some cases, there is a dual mandate, but that is not that common. It will be interesting to hear from the panels how do we see the economic growth dynamics today. I mean, at the same time, we are coming from a period where, for at least close to 10, 15 years, growth has been a lot dependent on fiscal and monetary policy actions. In a way, we're sort of at the end of the road in the capacity of fiscal and monetary policy to keep having an impact on growth, and now we have to go back and reassess what really growth is determined by, and that brings us to structural issues, as Zeta put it. So it will be interesting to hear from this. In any case, I have the strong belief that the best that central banks can do is to assure a necessary condition, although not sufficient condition for growth, and is to have inflation low and stable. It's easy said, but it's difficult to achieve. And well, precisely we are in this process. So with these introductory remarks, let me now jump directly into our panel. The panelist members were in a way chosen so that we can have a close to a global view. And we will start hearing from Ji Gang, Governor of the People's Bank of China. China is very important in Asia, and for the global economy, so it will be interesting to hear from him. Regretfully, he could not join us today. But then we'll pivot to Europe, and we'll have Christine give us her views on what is going on in Europe. So this will be two relatively lengthy interventions, and then I'll give the floor both to Perry from Bank of Indonesia and to Phil Lowe, and Raghu Rajan will join us virtually. I will ask them to make some introductory remarks, and then I will bombard them with a few questions. And after the dialogue we will have among ourselves, I will open the floor to all of you. So without further ado, let me now invite Ji Gang's intervention.
Distinguished Governor Setaput Sutiwa Narupu, General Manager Augustine customers, President Christine Lagarde, Governor Philip Lowe, Governor Perry Bajuyo, Professor Raghu Rajan, good morning. On behalf of the People's Bank of China, I would like to extend my sincere congratulations to the Bank of Thailand on its 80th anniversary. It gives me great pleasure to speak at this conference. I would like to take this opportunity to say something about the growth and the inflation. I recall that about 1 or 2 years ago, we were still debating whether the inflationary pressure was transitory or entrenched. Since the beginning of this year, however, most advanced economies started tightening monetary policies. Many central banks are hiking interest rate aggressively at a much faster pace than previous tightening cycles. And also, many emerging market and low-income countries have seen pressures of local currency depreciation, capital outflows, and inflation at the same time. Meanwhile, indicators such as mortgage rates and PMIs throughout the world show that the likelihood of a slowdown or a recession sometimes next year is on the rise. Central banks are faced with a delicate balancing act of fighting inflation and keeping the economy growing at the same time. As for China, our consumer price index right now is about 2%. This is particularly due to a bumper harvest in grain and stable energy prices. Our gas and oil prices follow global trends, but our coal price is just 1/2 of the international level. Our electricity prices have basically been stable since the beginning of this year. Looking for next year, the inflation forecast for China is in the moderate range. China's growth rate, however, right now is somewhat slower than expected due to COVID and other factors. Our third quarter growth rate is 3.9% on a year-on-year basis, but as you see, we have a pretty accommodative monetary policy in place to help with economic recovery and maximize employment. And our focus is growth right now. We recently cut the required reserve ratio by 25 basis points and also let the market interest rates lower a little bit. On top of its aggregate dimension, our monetary policy also has a structural side that is providing much needed support to agriculture, small and medium enterprises, private companies, and green finance. Looking forward, faced with a challenging situation, the advanced economies and emerging market economies need better collaboration on macroeconomic policies. That is why the theme of this session, growth and inflation dynamics, is so important. I hope the productive discussion here today will give us some tools to jointly tackle the difficult problems we all have on hand. Thank you very much.
Okay, well, thank you very much, Yigang. Very interesting points. Now let's go directly to Europe. and let me invite Christine to share with us your views on this very important challenge we are all facing together. Please, Christine.
Well, thank you so much, Agustin, and thank you to the Bank of Thailand and to the BIS for having organized such an anniversary. 80 years of age is pretty impressive, and I'm delighted actually to be with you, to be here physically, and to have a chance to discuss with many of the colleagues, governors, and other regulators from this part of the world, because I think that we have a lot to learn from each other. And a lot of the new concepts and new principles actually originated from this part of the world. Inflation targeting was something that not many people knew until and unless it came out of, what was it? New Zealand, wasn't it? Yes. Governor of New Zealand is with us. Wonderful. So, from my corner of the world, which is Europe, but more specifically the Euro area, what I would like to do in those few minutes that I was given to introduce, and while paying tribute to how you set the scene, both of you, because you really covered a lot of ground, I would like to tell you the story of 3 uncertainties, 2 interactions, 1 monetary policy. So 3, 2, 1. And I'll start with the uncertainties that dwell a little bit on what was mentioned in the introduction. We are going through a very, very challenging time where ground is shifting under our feet and where monetary policy is complicated by at least those 3 uncertainties, but I'm going to pick those 3 by priority. The first is the uncertainty about the short-term outlook, since the global economy is being hit by a series of very strong supply shocks that are pushing inflation and growth into opposite directions. This is visible in the global economy when I will call this group of countries affected by inflation the OECD countries, because numbers were released very recently. So OECD inflation reached 10.7% in October, of which 45% was food and energy. You'll understand why I mentioned specifically that. The global composite output PMI index deteriorated further in October, with both services and manufacturing falling further below the 50 threshold, and the number that was released this morning goes exactly in the same direction, declining yet again. Well, if you thought that that was bad, it's somehow worse in Europe. So, in Europe, inflation, as you indicated, Agustin, was very slightly down, and we're talking about headline here, but is currently, the latest reading for November was 10%, of which, and that's a number that really matters a lot, 70% was food and energy, as compared with the 45% that I mentioned for the OECD countries. 70% food and energy. The composite output PMI stood at 47.8 in November, so that gives you an indication as well of the activity. That's uncertainty number 1. Uncertainty number 2 is about how these shocks will actually affect supply and demand over the medium term, which makes it harder for us to judge medium-term inflation pressures. So when you look back, you have a succession of what others have called the polycrisis. Pandemic, horrible Russian invasion of Ukraine, that have accelerated pre-existing geopolitical major developments that I would call geopolitical shifts, which meant that continuously expanding supply, notably of labor, notably of energy, is no longer guaranteed. So these principles on which we had grown very comfortably in many corners of the world, based on the availability of labor, availability of energy, is no longer the case, and probably for years to come. 3 transformations are in play from our perspective in Europe. The first one is the role of China as an exporter of low labor cost, that is in question from our perspective. Second, European diversification of energy mix could mean higher energy prices for a while. And third, the acceleration of green transition could lower fossil fuel investment. All those three phenomena have a direct impact on price pressures and inflation. At the same time, these changes will also have an impact on demand, but the extent and the magnitude will only become clear in time. First phenomenon, less ability to rotate demand to external markets when domestic demand slumps. Second, higher energy prices could lead to investment shifting outside the euro area. The discussion that was just had yesterday between President Macron and President Biden might be giving us a little sign of hope, but clearly the Inflation Reduction Act is a case in point of an incentive for companies to look elsewhere where energy costs are going to be cheaper and where incentives are also going to be made available. Third consequence as well, writing off of carbon-intensive capital during the green transition. And I come to my third uncertainty, which leads me into my two interactions, which clearly have an impact on these shifting grounds and how we deal with inflation. The first interaction is the interaction between us, central banks, where clearly we are not only seeing, as you said, Augustine, global inflation, but we're also seeing, with the exception of two countries in particular, coordinated policy tightening by major central banks around the world that will certainly have spillovers and spillbacks, but with different effects and different time horizon. The US policy tightening, in particular, is found to affect industrial production as much in the euro area as in the US, and to lower euro area inflation over the medium term. That's for the medium term. But in the short term, insofar as it leads to appreciation of the dollar and a stronger dollar as a result, it can raise commodity import prices and increase inflation. And remember, commodity prices, in particular energy, generally transacted and denominated in US dollars, is 70% of the inflation that we have. Second interaction, so that's the interaction between central banks. The second interaction is the one between central banks and their monetary policies and governments with their fiscal policies. In the short run, in Europe, what we are hoping for, us, central bankers, is fiscal policies that would be based on what we call the triple T's: temporary, targeted, and tailored. Because those triple T policies can actually help alleviate the effect of the energy shocks and put a cap on inflation expectations. That would be the good case scenario. But fiscal policies that create excess demand in a supply-constrained economy might force monetary policy to tighten more than would otherwise be necessary. And regrettably, at the moment at least, some of the fiscal measures that we are analyzing from many of the European and particularly euro area governments are pointing in the direction of the latter category rather than the former. And how fiscal policy ultimately consolidates, that is, whether it cuts investment as it did right after the global financial crisis, will also be key as to whether supply constraints persist in the future. Now, given this exceptional uncertainty, I couldn't agree more with Augustine that what we central bankers have to do is to actually deliver a monetary policy that anchors expectations so that those expectations remain moored to the target while the various forces that I have mentioned before continue playing out. So to do so, we need to signal to the public, to the observers, to the commentators, that in all scenarios, inflation will return to our medium-term target in a timely manner. This is the best that we can do in the current environment. We can also raise our voice and explain how fiscal policy could actually either help or hinder And we can certainly use all the communication tools that are available in order to do so as best as we can. If we didn't do that, then certainly it would lead to large welfare losses for the population. The euro area cannot avoid the terms of trade loss that we are facing, which amounted to, in the second quarter of 22, to 2% of GDP. But if expectations on the top of that were to de-anchor, we would also end up with permanently higher inflation as the current shocks would become embedded, and as a result, we would have to harden even more our monetary policy adjustments. So this in turn implies that to achieve sustainable and balanced growth, coming back to growth now, it's not just going to be monetary policy. It's going to be for other policies to also act in concert. And it has to be different from what we saw over the last decade. Public investment after the global financial crisis was a main casualty in Europe. And at the time, the structural reforms that were so much needed and advocated were not really put in place either. So, euro area government at that time invested around 500 billion less in the period from 2011 to 2019 as compared with the period 2000 to 2009. And after the great financial crisis, the European Commission revised down potential output by between 8 to 10% after 10 years compared with the path that it expected before the crisis. These are the errors, if I may say, that we must absolutely avoid this time around. We need higher investment and structural reforms to remove the supply constraints and ensure that potential output is not impaired by the changing global economy. And that's a big question and an uncertainty that we have. This will be particularly important in the energy sector and in the strategic supply chains. And in a world where external demand is more uncertain, we will also need to strengthen domestic supply and demand through higher productivity growth. This will be particularly true in digitalization. And if you just consider that only around half of EU firms innovated or adopted new technologies in 2021 compared with close to 2/3 in the United States, quite a lot of ground has to be covered. But it can be covered with the right policy mix and with actors working together in a slightly different fashion than what they did after the global financial crisis. I'll stop here.
Thank you very much, Christine. As usual, very well structured your commentary. In particular, I like very much this 3-2-1 formula. Very clear. Now let me give the floor to Philo. Please, Phil, the floor is yours.
Thank you very much, Augustine, and I'd like to extend my congratulations to my many friends at the Bank of Thailand for reaching 80 years. It's a fantastic achievement. What I'd like to do is to briefly talk about the situation in Australia and then to continue the reflection on the change of global inflation dynamics. The inflation situation in Australia is very similar to that in most of the other advanced economies. Inflation's 7% at the moment. It's expected to go a bit higher, but then to start coming down next year, and we think it'll take a couple of years to get back to the target range. Inflation expectations are still very well anchored. Wage growth has picked up, but at the moment it's not at a rate that's inconsistent with inflation returning to target, which is good news. Our real economy has performed really well. We've bounced back strongly from the lockdowns of last year, and the level of output now is significantly above where it was before the pandemic. The unemployment rate is as low as it's been since 1974, so we've had the lowest unemployment rate in 50 years. Labour force participation has been very strong. The employment to population ratio has never been higher than it is now. Labour market's tight and the borders are open and immigration has started again, and the rate of population growth has returned to where it was before the pandemic. So the labour market is doing very well. National income's also pretty strong. We're on the other side of the European terms of trade hit. Our terms of trade are the highest they've been in 150 years. So national income is strong, the labour market's strong and the economy's bounced back, and domestic spending so far has been resilient in the face of higher interest rates. Partly that's because of all the saving that was done over the past couple of years when people couldn't spend and the lockdowns were in place. So to date the real economy has been very strong. In terms of monetary policy, we've lifted interest rates by 2.75% since May. By my count, we were the first central bank to step back to what's considered normal interest rate increases. We moved to 25 basis points in October. We did that after having made 4 moves of 50 basis points. That decision was really grounded in the recognition that we've already made a large cumulative increase in interest rates, and there are lags in the implementation or the effects of monetary policy on the economy. I think it's quite possible that the lags will be longer this time, partly because of all the savings that people did in the last couple of years. We also recognise that there was a combination of a weakening global economy, everyone raising interest rates, real incomes are declining, housing prices are declining, and households will be making a record share of their disposable income in interest payments next year. So you put all that together, a weakening global economy, declining real incomes, declining housing prices and record interest payments, and everyone raising interest rates. And it's quite plausible that sees spending in the economy slow next year, and as the supply side problems get resolved, slower spending, better supply side, inflation could come back down, and we recognise there are lags in the operation of monetary policy. We're still trying to tread that narrow path of bringing inflation back down without the economy slowing too much and losing all those hard-won gains in the labour market that it's taken us really decades to achieve. I think it's still possible, at least for us, to tread that narrow path, but it's going to be pretty easy to be knocked off it. And our priority will be to get inflation back to target over the next couple of years. So that's the situation in Australia. I just would like to continue the discussion we've been having about changing global inflation dynamics. For the past 25 years, we largely thought of our job of moving interest rates around to control aggregate demand. If inflation was too low, we'd lower interest rates to stimulate spending, get inflation back to target, and the reverse if inflation was too high. The supply side was benign and was actually mostly helpful, as Christine said. We became very used to very little variation in inflation. It was in a very narrow range all the time, and we became extraordinarily focused on whether inflation was 1/4 or maybe even 0.5% away from our targets. I think we became overly focused on that issue. We talked about the great moderation. Inflation was varying within a 1 or 1.5 percentage point range, and for a while there we were worried that inflation was too low. It was 0.5 or 1/4% above where we wanted it to be. I think we'll look back on this period as an extraordinary period, not boring, as Mervyn King said, but it'll feel boring relative to what comes next, I feel. Looking forward, the supply side is going to be much more challenging, as we've already talked about. I think we're going to have to deal with a lot more variation in inflation from year to year than we've had for the last 30 years. We've already covered some of the reasons for that, but I've got 4 on my list. The first is deglobalisation. The second is the changing demographics, the declining populations in many of our countries and the ageing of the populations. Climate change. Surely we're going to have more extreme weather events which are going to disrupt the supply sides of our economy and lead to more variability in prices. And the fourth is the energy transition. There's a lot of investment going in renewables, as there should be, but the existing capital stock producing energy is depreciating very, very quickly. Either it's being decommissioned or firms are not engaging in a lot of maintenance because they know that eventually these plants will have to be shut down. So I think we're going to see more frequent examples of where demand is running up against the ability of the global system to produce power and electricity, and that's going to lead to more price spikes, not just in electricity, but it'll have ramifications right through the production chain. So deglobalisation, demographics, climate change and the energy transition all mean inflation is going to be more variable. And I think we'll look back on the last 30 years as a bit boring. if inflation is going to be more variable, it makes the credibility of the monetary policy regime more important than ever. We really want people to believe and understand that when inflation moves away from target, that's going to happen more often, that it will come back. If they don't believe that, then deviations of inflation from target will be more persistent and it'll be harder to get it to come back. I think that's, in my mind, this is another reason why at this particular juncture it's really important that we get inflation back to target. This is the first test in the current, I think in the new world, where inflation is going to be more variable. So it's the first test. Inflation's moved out of the range that it's been in for 30 years, and we need to demonstrate to the public that inflation will come back down. If we don't pass this first test, then the next tests are going to be even harder. So if you think about this in a longer term perspective, we've got to be able to demonstrate to the public that when inflation moves away from target, it comes back. So it's really important that we pass this test, or the next ones are going to be even harder. Thank you. I'm sorry I can't be more cheery.
Thank you very much, Phil. Very interesting. Now let's come back to Asia, and Perry, the floor is yours.
Thank you, thank you, Agustin, and let me start by congratulating Bank of Thailand, Governor Starput, and all my friends in Bank of Thailand. 80 years, always the great years, and of course, wishing all the best for the next years. Well, of course, just on the topic of today, how the global spillover to every country is, of course, this is still sleepless night of the central bank, especially us. But that will also depend on especially two things, how the impact of the global spillover to region as well as a country. One, the state of the economic development of a country. Of course, Christine already mentioned, US, Europe, both the inflation dynamic is coming not only from the supply, also the demand side. Intertwining between the two, the dynamic more severe there. But in other countries in Asia, we just recover. Indonesia, for example, we are still on the territory approaching of zero output gap. So our inflation is still more on the supply side. Cost, food, energy, global price, food, rather than demand. Then I think many countries, emerging countries, also facing the same thing. One, in emerging country, Indonesia, including that our inflation more supply driven rather than intertwining with the demand driven. Second, Christine, right, how the policy respond, especially not only from the central bank credibility, but also the coordination between fiscal and monetary policy. Because to address the inflation from the supply must coming from fiscal. The demand is coming from monetary. This is also very important. And Indonesia also fortunate that we have very close coordination between the two, the fiscal monetary policy. Let me just go into detail. We are grateful our inflation is coming down. 4 months ago is 6.9 to 5.9, now it's 5.4% CPI inflation. Our core inflation is very muted. 3.3% last month, this month is about 3.1%. We have a target 3% plus minus 1. So this is showing that more on the supply side driven inflation rather than the output gap demand side driven. Our economic growth quite positive, 5.7% last quarter, the third quarter, both from the export and domestic consumption. This year we are expecting 5.2%. Next year will be about 5%. Both from the export and domestic demand consumption keep rising. So I think we are grateful that Indonesia is one of the best performance with very low inflation. On the inflation, we are aiming core inflation we will bring down to our targeted level in the first semester next year, and the CPI inflation second semester next year. This is the dynamic. This what we are expecting. So when we are facing only in the supply side, then we have to be careful how to address Indonesia more on the supply side. Then actually our inflation is still about muted and economic growth good. Second, on the policy, we have very close coordination between government. I'm independent, BI independent, but I'm talking very frequently with my president, my dear friend Minister Sri Mulyani. We are always discussing how best we coordinate with our respective independent to steer the country economic from the global spillover. Three policies that we are coordinating. One, on the fiscal. This is the last year, 3 years, we are under emergency law of the COVID, whereby the fiscal deficit of Indonesia can succeed 3%. This year, 3.8%. But starting next year, fiscal deficit will come back to below 3%. This is under the law. Under the emergency law for this last 3 years, this is the last year, central bank can also participate in direct financing through government's bond purchase only for the social program as well as for humanity, purchasing vaccine, health, and so on, not for the general funding. So when we are seeing the global spillover from the war in Ukraine and others, high commodity price, energy price, we discuss one, the fiscal giving more subsidy with some part of the financing of the central bank, and we are debating what the best delivering the subsidy. Whether, I think the 3T is very important, what you're talking, Christine. Fiscal subsidy, whether for the social program or some part of the price subsidy. Under the normal time, the best is more direct transfer. Don't go to the price subsidy. But when we are facing this is higher commodity price and energy price from the global, then we allocate more on the price subsidy and some part of them from the social program. Thereby, with giving subsidy to the price subsidy, our inflation relative muted. This is what we have. Some part, of course, for direct transfer from the social program. Because the two of them will have direct impact on the consumption. If we allocate all of them to direct transfer, inflation will be very high. Consumption will be also being driven down. And of course, the policy response of the central bank will be more severe. So we are grateful to have coordination there, more subsidy, price subsidy, as well as the social program. That's why we are having inflation very low. Second, on the monetary policy, of course, we are quite responsive. We are front-loaded, preemptive, forward-looking. Over the past 4 months, we already increased 175 basis points from 3.5%. Now it's 5.25%. I'm waiting for Bill to do your policy, and also the Fed fund rate, how it's actually do. This is preemptive, forward-looking, and front-loaded interest rate response is very important to bring down, to mitigate the inflation expectation. Our inflation expectations coming down very rapidly. Close to 7% 4 months ago, 6.9%, but now already approaching to 5.5%, approaching to our forecast. So the gap, we are measuring between consensus forecast and our forecast, internal process. Now the difference is closing. 4 months ago is very high. We are forecasting back then 6.1%, but consensus forecast is 6.9%. But after we are aggressively responding to interest rate, then the gap between consensus forecast and our forecast is narrowing. It's almost the same. Second, on the monetary policy, this is probably, we always debate with Bill and Christine on the exchange rate. For emerging countries, including Indonesia, exchange rate policy is a matter. Because when we are facing high energy price, at the same time, very strong dollar year to year, probably appreciating by close to 25%. The dollar index was 114, now it's already declining. Our choice, whether we want to depreciate also with 25%, or we have to narrow those depreciation. That's the choice. So we decided to narrow, to lower the depreciation, which is actually our aim is to address the imported inflation. The nominal exchange rate pass-through is very small, about 8 to 11 basis point for 1% nominal depreciation to inflation. But when we are facing with $90 energy prices, oil prices, those nominal term to domestic inflation is very high. So this is why we do intervention in our exchange rate policy, of course, to reduce the volatility, but also to mitigate the imported inflation. That's the reason why our inflation relatively low. First, fiscal subsidy. Second, aggressive interest rate response combined with exchange rate stabilization for imported inflation. And lastly, this is particular, probably not happening in Australia, Europe, but many happening in emerging countries, including Indonesia, when we are facing 16 million island, the food price. Food price in Indonesia consists of 20% of CPI. When there is high commodity price, global energy and food price, the supply and distribution nationally become disruptive. The third policy that we introduced under President Joko Widodo direction to the local government, and Sri Mulyani also giving incentive to local government, the national movement to fight the food inflation. And both Bank Indonesia and Minister of Finance going there to pursue it and to coordinate with local government. We have competition. Whoever the local government can beat the food price, then we are giving award. About 4 months ago, the food price about 10.3%. You can meet where 10.3 times 20% of the CPI is a food price. How much its contribution to the food price to CPI? But now our food price coming down rapidly to 5.4%. This is actually direct, intervention of supply and distribution of production in when you are facing divergence in domestic supply chain is very important, and this is very effective. And we are also joining our government through our 46 branches, because we have choice. If we do not do that, 20% times 10% of food inflation, how much CPI inflation, how much inflation expected, how much we have to raise interest rate. It's more costly when we intervene the supply side driven inflation through interest rate. So I think that's actually what we have. One, we have to mindful where is the state of the economy. Whether the dynamic of the inflation and growth coming from the supply only or also intertwined with the demand. Second, that's determine the response. whether only from monetary policy, if this is demand, but in many cases of the country, everywhere, there's also supply side. The fiscal is very important. The fiscal, the treaty of Christine mentioned, I think we made it, but normal time, prices with this bad, it's wrong, but in this time situation, it's needed. Otherwise, our inflation is very high, interest rate response is very also, very high. And of course, monetary policy, the standard that we know, credibility, quick interest rate response for emerging market, of course, intervention, stabilization of exchange rate. Lastly, to be innovative in emerging country, I don't know in South Africa, but in our Indonesia, direct intervention of the food price matter. Thank you.
Thank you very much, Perry. And now, last but not least, let me give the floor to Raghu Rajan, a very good friend of all of us, ex-Central Bank Governor of Reserve Bank of India, great professor at the University of Chicago. So Raghu, the floor is yours. Great to have you here.
Thank you. Augustine, and sorry to be like big brother watching all over you up here. Thanks to the Bank of Thailand and the BIS, and congratulations to the Bank of Thailand on your 80th birthday. Let me wish you a long and independent life. So I don't have a central bank to run. So let me take the independence I get to ask a question, which is, why do we have this great inflation, and to what extent is monetary policy to blame for it? It's too early to levy blame, but the reason I'm saying this is really to think about how we sort of set policies for the future, including in this fight against inflation. And let me just explain what I mean. Clearly, we've had various unexpected shocks: the pandemic, and as well as the supply response to the pandemic, the war, and the tremendous fiscal response in many industrial countries. But still, there is a question that can be asked, which is, was monetary policy too accommodative for too long, given the enormous fiscal as well as supply chain effects that were emerging? And as a result, have we been forced to raise interest rates overly rapidly in order to catch up with attendant stresses on the economy? It would have been nicer if we had started earlier with longer time to observe the actions, and perhaps that would have shielded us from the possibility of mistakes down the line, of being perhaps a little too contractionary eventually. And I want to point to what the BIS said in its annual report, which I thought was very, very thoughtful and insightful, when it described really two inflation regimes, a low inflation regime and a high inflation regime. That suffices for what I'm going to say. In the low inflation regime, sort of shocks are essentially absorbed. They don't precipitate correlated moves in prices elsewhere, and you get higher inflation. Effectively, nothing disturbs the regime, and that looks like what we had between the global financial crisis and the pandemic. And then you have the high inflation regime, which was what was before the global financial crisis, and what we have now, where every sort of disruption seems to feed on everything else, and we get significant price reactions to everything. And to some extent, the question is, were our frameworks and policies that we had before the pandemic, and that we then adapted to the low inflation regime, did we go too far? Or were the policies nimble enough? Were the frameworks nimble enough when the regime shifted on us, perhaps due to no fault of the central banks, but because the external environment, the pandemic, the fiscal authorities changed the regime for the central banks from the low to the high. And then the question then comes, how do we set policies going forward? How do we set frameworks going forward that allow us to not get locked into a particular regime as and when the regime changes? Of course, you may say this is not a big deal because we're not going to see so many regime changes, but the costs of having the wrong policies or the wrong frameworks when the regime changes can be substantial. And I take what Governor Lowe said about the likelihood that we will have somewhat volatile inflation going forward. But of course, volatility can also take us back to a lower inflation regime. Certainly, volatility in growth can take us back. I mean, if you think about all the headwinds to growth that face us now with aging, with lower immigration and opposition to immigration, with fiscal room having diminished significantly across the globe, with deglobalization, with China slowing and no longer providing that engine of growth which the world had come to rely on, and with many emerging markets facing K-shaped recoveries, yes, there are silver linings in the cloud. Maybe the green investment, the green revolution will help us revive investment and growth. Maybe digitization will help us. But we should be prepared to potentially go back to the low inflation regime. So are the policies we adopt now going to be compatible with that? And more important, what have we learned from the previous low inflation regime? What policies should be willing to follow in that regime to get us back to growth? What is reasonable? What is too much? I think we will learn a lot over the next few years, and it would be good to keep in mind sort of how we change the nature of central banking as we go along. What should we do and what shouldn't we do? Let me stop there and over back to you.
That's when we want the answer. Come on.
Another question.
You have to give us the answers.
I wish I knew.
Yeah, I mean, at the end, central banking is an art, not a science. So we have to become a little bit of artists and have our imagination work for us. Now, let me get the discussion going. I will ask a question directed to each of the panelists, but I invite the other panelists to pitch in the answer or generate a little bit of a debate, and then we can open the floor for the audience to also express their views or ask questions. So let me start with you, Christine. In your very interesting commentary, you mentioned the exchange rate as an aspect to be watched, in particular because it affects imported inflation. And this is something also that Perry mentioned in his intervention. And I can say that, for example, in Latin America, a good motivation for early tightening was precisely to avoid the exchange rate channel as a process of affecting inflation. Traditionally, advanced economies do not necessarily pay that much attention to the exchange rate, just because there are large economies and the external sector relatively is not that big. But this seems to have changed. It probably has a little bit to do with the global nature of inflation. But in any case, it would be interesting to hear from you, Christine, if you can give us a little bit more of light on how the exchange rate plays a role in your policy determination, and how are you focusing that aspect?
Well, conventional wisdom will tell you that we do not target any exchange rate.
Yes.
Okay. And that obviously we are monitoring and that we are very attentive to variation of exchange rates, and in particular we are monitoring carefully what has been an appreciation of the dollar, which, you know, over the last, despite the most recent depreciation relative to the euro, has been in the range of 12 to 13% in the last 12 months. But I would say that in terms of impact on inflation, it is probably less so the case in Europe, and notably in the euro area, because about 60% of the trade of the euro area is actually trade amongst member states, and therefore we are, as far as those 65%, immune to the variation and the appreciation of the dollar. Of course, a lot of the energy, in particular oil, less so gas, but oil definitely, is transacted in US dollars, and that has an impact given the importance that energy has had in inflation in the last 12 months in particular. But it's probably more so the case in some of the emerging market economies, and probably Perry is more impacted than us in the euro area. And I would say that there is more of an impact through the financial channel than through the expenditure channel, for sure.
Absolutely. Perry?
Well, this is actually the issue that all of us, the central bank, must thinking ahead, the energy. Because the problem of energy is not only about the economic production, but also the supply disruption. But the supply disruption also from the politics, the tensions of geopolitics. Second, I think the problem, as Bill also mentioned, will be lingering for some time, but because the energy transition take years. So we have to face that. The problem of inflation and the ramification of the growth dynamic going forward from the energy. Then how we have to respond in that? Well, frankly, this is the challenging. As I said, Indonesia fortunate for the last year. This year we still have opportunity to have fiscal deficit, subsidy, and so on. But going forward, then actually the room for fiscal space is becoming limited. The adjustment, the transmission of global energy price to domestic inflation becoming more severe. Well, this is the balance between inflation and growth. First, we have to rethink whether we will be, disciplinedly targeting toward our medium-term inflation to 2%, and what is the cost of growth? Come back to the Philip curve again. The balance between inflation and growth nexus. If we want to do 2%, then the growth we have to stay, to settle with very low growth, because inflation must be addressed to higher interest rate response. This is the choice, a hard choice, while waiting for the energy transition to replace the fossil to non-fossil, climate, green, and so on. Take years. That's on the inflation and growth dynamic and how we have to respond both from the fiscal and monetary. Second, on the financial sector, this is also a challenging. Even now, I also frequently, Christine, being complained by my fellow bankers and even my investment manager, because they want, and we also from the government central bank, we want to transition to energy. Developed country able to develop a good project, but emerging country like us, we have to still learn. Developing the green project is not easy. The requirement, the environment, and also the structure of the project. Once we do that, the structure of the financing, and then have to come to our bankers and investment bankers. now they face with the investor. The investor demanding the transition cannot be 5 years. The transition of the energy for the financing must be now. So my fellow bankers and financial community have difficulties now to find the project at the same time, and being pushed also from the investor cannot finance to non-green project. This is more on the balance sheet of the corporate, balance sheet of the financial sector. This is where BIS, Augustine, when we are talking about macro, monetary, macro prudential policy framework, and the theory, the framework easy. When we are facing monetary, macro prudential, facing inflation, dynamic, growth dynamic from the high energy price and take time for transits. At the same time, the financial stability issues facing the problem now, where the banking have difficulties to raise funding because the zero finance movement from the investor.
Yeah.
Well, let's just sleep tonight and for tomorrow then.
Very good, Perry. Now let me move to inflation variability and the shift between regimes, an issue that was mentioned by Phil and Raghu. Phil, how do you think the addition variability or the enhanced variability in inflation will affect precisely or should affect the monetary policy frameworks? I mean, in a way, the previous regimes meant that we had variability of relative prices, but those variability of relative prices did not fit or did not provide information about future inflation. I think when you shift from one regime to another is when people are extracting information not from relative prices but from the variability of inflation itself. So analytically, how do you think we should focus on this issue? And yes, Raghu, I think I would also invite your thoughts on this issue.
Yeah, that's a tough question. I'm not sure I've got the answer, but what I do know is that even if the world has got more supply shocks, it doesn't reduce the need for us to focus on inflation as our core objective. So we've got to keep in mind that our main job is price stability. I think over the last 30 years we got trapped in a world where we thought price stability should be defined in a particular way, that inflation gets kept in a very narrow range. I think it's unlikely we're going to be able to do that in the future. Inflation's going to move around a lot more, isn't it? And that doesn't mean that we can't hit our inflation objectives. I think we can still do it, but we've got to be able to demonstrate to the public that when it does move away, it comes back. And this is why I think in the current episode it's so important we're able to do that. It's going to be harder for the private sector to work out what shifts in the general level of prices and what's relative price shifts. So that's going to make it harder for resource planning. But our job will be to make sure that this variability, we always return to the target, and then inflation averages 2 or 2.5% in our case. We'll just live with more variability. And we've got a job of explaining that to the public. And I think also explaining that we've lived through a period where we're able to contain inflation in our range, but we're probably not going to be able to do that in the future. And so there's an education to go on as well for us. And the other thing that I think Christine touched on this is if there are more supply side shocks, the best response to that is flexibility on the supply side, to addressing the supply side so that when these shocks come that things can be, adjustments can occur relatively quickly. We can't, as central banks, do very much about that, but the political and business class can. So I don't know how it changes the analytical framework, but I know it doesn't change our basic job of delivering a low rate of inflation that averages 2 point something.
Let me push a little bit more, and then I give the floor to Raghu. I mean, and let's go back, let's say 18 months. 18 months ago, we were trapped a little bit in this debate between you know, I mean, our framework, part of our framework says that if we are looking into even a sequence of relative price changes, that doesn't necessarily mean a generalized increase in board prices. And sort of the doctrine in central banking would say, let's just look through it, you know. So in a way, we sort of had an initial reaction, or our reaction function in a first instance was, let's wait and see, you know. But then, you know, I guess relative price changes were combined with aggregate demand shocks, and it became generalized. Now, do you think that this should make us to be a little bit less patient about how to digest or internalize relative price changes? Do you think the problem is how to identify relative price changes? Yeah. I mean, it might be that we are invited to have a more proactive monetary policy.
No, not necessarily, because we've just come through a truly unique period. We had a sequence of supply shocks. It just wasn't one, it was a sequence. And the starting point was interest rates at a record low level. In most of our countries, interest rates were zero, which is incredibly unusual. It's unusual to have a sequence of supply shocks. And I think the other dynamic, and this partly goes to Ragu's question about where we got the inflation from. We talked a lot about the supply side, but there was a huge amount of demand stimulus.
Yeah.
I know in Australia we had a very much an insurance mindset. The pandemic was so dire, the economic consequences of that were truly catastrophic, we thought, and that there would be deep and protracted scarring in the economy, perhaps for years. And with monetary policy and with fiscal policy, we wanted to provide maximum insurance to the society against the truly worst possible outcome. And it turned out we didn't get the worst possible outcome. Then we got a vaccine, people got vaccinated, and we bounced back fairly quickly. So we didn't need the full insurance policy. But the full insurance policy imparted a lot of stimulus into the economy at a time when interest rates were zero and we had a sequence of supply shocks. So it's a truly unique period. I think going forward, we will hopefully be able to return to a world where we can look through supply shocks, provided that the public is convinced that inflation will come back to target when we get hit away. This is why I think the current episode is so important, to demonstrate that we will do that. If we can do that, then as long as we don't get hit by a sequence of supply shocks in the future, possible, but if we don't, then we'll be able to look through and go back to the textbook. Inflation goes up for a while, but then it comes back painlessly. But we've got to show that we can bring it back now to make that happen.
Absolutely. Raghu, your thoughts?
Well, let me try a different tack, which is why were we so willing to label these relative price movements and not recognize that it was perhaps a little more than that? And part of it may well be that you know, our instruments, right? Remember, the whole idea behind quantitative easing working was that one of the elements was we're not going to raise interest rates until we end quantitative easing. And then we will be willing to raise interest rates, right? And the whole point about quantitative easing working as an instrument was, you know, we're going to give you a line of sight about how long this is going to endure. And so you should be confident we're not going to raise interest rates until it ends. And we're going to be very, very open about when that is going to happen. So in a sense, it was an instrument for the wrong regime. It was an instrument for a low inflation regime when you wanted to build credibility that you will not raise interest rates, you know, hastily. You will be, as Paul Krugman once put it, rationally, credibly responsible because you don't want to hurry to attack inflation. That's the way you get inflation up. And the whole problem was we had too low inflation. Now, you know, arguably that was what also constrained us. Whether it was, you know, we didn't recognize the inflation building, but also whether we were actually waiting for our instruments to play out wanting to preserve them for the next time we had low inflation. If we broke the credibility this time by acting too quickly, then perhaps the instrument would not be available the next time we had low inflation. How much did that play a role? And then it raises the more important question, if we are going to a more variable regime, is this the kind of instrument we should have, or should we put it in the closet and bring it down only when we are deeply in trouble? I think that that's what I was in a sense referring to in going back and examining what constrained us.
Yes, please.
Yeah, I want also to I want to echo what Philip was saying, because there was something so specific about what we've just been through. When you look at how brutal, how rapid the energy shock was, I mean, in and of itself, you should have probably doubted that it was transitory, that we were going to see it through, because of the brutality, because of the rapidity at which it overwhelmed all of us. But that's not enough. I think there was, on the top of it, the geopolitical changes, the shifts, the transformation that were in play, that associated with it, actually transformed that episode. You know, if you compare it with the oil crisis after the Iraq War, it didn't last long. It was about 6 months, and then prices came back. But if you look at what happened when OPEC formed and coalesced and concerted, and the Iranian revolution, those were much longer developments, because it was associated with not only the oil crisis, but also transformation that were going to restructure relationships. We had pretty much the same kind of situation now, which maybe we had forgotten, but certainly for which we were not equipped for the reasons that Raghu has just mentioned. And if you combine that with something which to us is quite mysterious, which is the rapid pass-through that we are seeing at the moment.
Yeah.
You know, between producers' prices to industrial prices, the speed at which it's going through, not entirely, because I don't think that we've seen the end of it, but a large amount of pass-through in such a short period of time is also something that is very unusual, and we were not used to.
Excellent. It might have to do with supply chain problems and so on, which makes it a really complex environment. Perry?
Well, let's take a moment, not only looking the problem on the monetary. We have in the game theoretic approach, we have two objectives, inflation, which is also coming from demand and supply, right? This is inflation and growth dynamic. There's two instruments, which is monetary, interest rate, and fiscal. We learn if supply side inflation, the dynamic must accrue from the fiscal, right? The demand is from the monetary. This is game theoretic approach, the dynamic that we are facing. And Christian just mentioned, the dynamic is very quick because what we are facing globally. So what is the solution? One choice, let's do the corner solution. Just whatever the inflation coming from, just bang with monetary policy. Forget about the fiscal, right? Well, we can tame the inflation, of course, very severely with high interest rate. The outcome will also very volatile, very up and down growth, because the growth is just residual. This is the corner solution if we only address the two objectives, the dynamic inflation and growth, only from monetary policy. This is one corner solution. Or we want to opt for the Zuckerberg solution in the middle. This is probably more ideal. When the country politics, of course, have a room for that, which is counter-cyclical monetary policy that we do, interest rate for preempt the inflation expectation going forward to tame the inflation from the demand side, and of course, collaboration with the fiscal, which is also counter-cyclical from the supply side of the inflation. I think Raghu and others, I think this Zuckerberg solution is, I think, more optimal rather than the corner solution only relying on interest rate to address the dynamic. But coming back again, the political dimension of the global and its respective country will determine whether we are opting the corner solution with much more previous impact or more, optimal solution.
And we have learned that at the end of the day, it's not always possible to have the coordination, but we have also learned that if there is a fair amount of congruency between both policies, we can end up with a terrible result. Yeah. So we have addressed many very interesting issues about central banking. We have a few minutes to see if any of you have a question for any of the panelists. Yes, please. Here, the mic is coming.
Thank you. Let me turn the tables and ask a question to Raghu. Raghu, when you were the governor of the Reserve Bank of India, you wrote a bit on the implications of advanced economy monetary policies, advanced economy central banks monetary policies for emerging markets. That was a different era. Actually, the challenge was appreciation of currencies in emerging markets. Now, of course, we have this highly synchronized contractionary policies that challenges depreciation. So when you think about what happened at that time and what's going on now, how your recommendation to advanced economy central banks has evolved, or it is still the same advice, or you think that there is space for coordination or thinking deeper about coordination, given that these policies are often synchronized in one direction or another direction?
Let me collect one more question, and then I'll offer the floor to the panel. Setaput, please.
Yeah, question for Philip. If you take the stuff that you've been referring to and some of the other panelists have talked about, one, probably greater variability in inflation. Two, maybe greater relative price shocks. Three, maybe sometimes a need, if it's coming from the supply side, to look through inflation. Does that add up to a situation where we should think about widening the bands of our inflation targeting framework?
Any other question? Let me add one last question for Christine. Christine, you are, for my knowing you for so many years, you are a master in communication. So how have you dealt with your challenges as central bank governor? I mean, what, given your past experience, what is so unique, or what advice do you have for central banks in the communications field? Having the advantage of both coming from the outside, but now being in the inside. So let me start first with Raghu, and then go with Phil, and then Christine.
Well, I was going to add a question for Christine, which is following on Augustine, which is, Christine at the IMF was fantastic in coining, very brief terms, fully describing the regime we were in. I remember globalization, lowflation. I mean, these are all terms of what would you characterize the current regime by, what we're going through right now. But to the broader question, I think the emerging market central banks have done a wonderful job this time in anticipating the necessity for a rise in interest rates. Many of them have been moving for some time, Brazil and Mexico. And to some extent, people keep asking where is it breaking in emerging markets? And of course, many are under some stress. But given the rapidity of interest rate rises in industrial countries, it is quite remarkable that so far some of the stress has been well borne by the emerging markets. And I think that's because we've learned the lessons over time. We sort of know what to expect. We did understand there would be a transformation in capital flows, and many of the emerging markets anticipated that. So I sort of think, where we were, it is hard to expect a coordinated strategy. Every reserve country's central bank has to do what it has to do to get inflation under control. It would be good if it was a slower pace, but given where they are, that's the pace they think most appropriate. And to some extent, the emerging markets have to adopt policies which are reactive to that. In this case, they forecast what was going to happen and reacted well in advance, and I think it has served them well.
Thank you very much, Raghu. Phil.
Thank you. The question was, should we be thinking about widening bands? And I mean, that would be one possibility, but that wouldn't be the way that I'd incline to go, because I think what we've got to do is to keep the focus on the medium-term outcomes, and that we're going to deliver an average inflation rate of 2 or 2.5% over time. So I think if we say, well, we're always going to keep it within some range, we're, in this more volatile world, we're going to have repeated instances of failure. But we should be able to deliver for our communities an average inflation rate of 2 or X or whatever it is that we choose, and just accept that there'll be variation. The specification of the inflation target we have in Australia is, on average over time, we'll deliver an inflation rate of 2 point something. Some people in the past have criticised and said, what is on average, what is over time, what does 2 point something mean? And so you can get trapped into this world, but in the end, we want to deliver an average rate of inflation of 2 and a bit, and convince people that that's what we're doing. We've really done that, and when we're away from that, we'll come back to it. So I don't like the idea that we're going to kind of focus on the boundaries. I think the focus of the communication needs to be on the average, and we always come back to the average when we're away.
So, Christine.
Well, communication-wise, we have adopted a different approach, and our strategy review was deliberate in avoiding the close to but below, and was, targeting specifically to in the medium term and symmetric. To your point, Agustin, one, I'm not the ultimate communicator.
Yes, sure.
but what I find particularly challenging with the kind of communication that we have to use, and which is one of the key tools that can be exploited, is that it leads you to being very schizophrenic. Because you have to, you address a particular audience which is attentive to every single word, comma, inflection of voice, movement of your eyebrows, different calibration of association of words. And then you have the other audience that doesn't understand anything that you have said to the first audience. And yet that second audience has to be convinced as well, because inflation expectations, of course, are the products of all these wonderful forecasters, surveys, and professional but it's also going to be the consumer's expectations that will drive the show. And it leads you to having to try to avoid inconsistencies between those two languages that don't talk to each other, and those categories of audiences that ignore each other, and probably rightly so.
Very well described.
To Raghu, I'm going to think about it, but I would say over to 2 by all accounts.
Very good. Well, colleagues, thank you very much for this very lively debate, very interesting positions. I think it has illustrated very well the nature of our huge challenge of dealing with an ever-changing dynamics of inflation and growth. So please join me in giving a hand to our panelists.
Well done.
Thank you.
Thank you very much, all the speakers. Ladies and gentlemen, next we will have a coffee break for 20 minutes. The break will be served in front of this room. Please kindly come back here for the next section at 11:35. For heads of delegates and speakers, I would like to invite you to a group photo session, which will take place at Saman Samosan, that is the opposite of this room. Our BOT staff will guide you to the venue. Ladies and gentlemen, welcome back to the conference. I hope you all enjoyed the break. Now we are entering the second session, a digitalized monetary system in the making. Without further ado, allow me to welcome Ms. Haslinda Ayman, Chief International Correspondent for Southeast Asia and anchor from Bloomberg, to share this session. Ladies and gentlemen, to lead off this topic, please join me to welcome Ms. Susan Athey, Professor of Economics and Technology, Stanford University, who joins us virtually. Please let me introduce all the panelists in this session. Ms. Eddie Yu, Chief Executive, Hong Kong Monetary Authority. Mr. Chang Yong-ri, the Governor of the Bank of Korea. Mr. Adrian Orr, the Governor of the Reserve Bank of New Zealand. And Ms. Cecilia Kingsley, the Bank for International Settlements. Ms. Ayman, the floor is yours.
Thank you. Thank you for joining this panel where we'll explore whether or not a digitalized monetary system is in the making. Brazil's central bank governor lamented recently. He said, "It is easier to move money from Sao Paulo to London by boarding a plane carrying bags of cash than it is to do it through the banking system." Presumably, he was suggesting that the banking system is obsolete, perhaps, and it is more expensive to do so, antiquated. It is also one reason why the monetary system needs to move with innovation. And to that point, more than 100 central banks, i.e. 80% of central banks in the world, are exploring or engaging or even embracing their own digital currency. They're hoping to reap the rewards of a system that's more efficient, that's more reliable, that's probably cheaper and more inclusive. There is potential for it to be more inclusive, to bring in the unbanked into the financial system. So how do central banks adopt new technologies shaping the monetary system of the future? Well, to get it started, I'd like to invite our lead-off speaker, Professor Athey, who joins us virtually. Professor, please.
Please give a wave if anything's wrong with how this all is coming through. I really appreciate the opportunity to speak with everyone today, and I'm so disappointed I can't be there in person to interact and learn from all of you. And I also just wanted to say that my comments today are my own personal opinions and not those of any institution. I'm on partial leave in the US government right now as well. So I wanted to make a few comments about the backdrop of technology in the financial system to help understand why we got here and also to help think about the forces around the monetary system that are shaping how it develops. And so just to start with a few comments about digital transformation in the financial sector. One reason things are so hard, at like the difficulty of moving money or making, doing other types of things that seem to be simple with today's technology, is that large organizations face challenges with both the incentives and the execution for innovation, particularly banks and government. This is a problem that's pretty hard to fix. But there are some important trends that are changing and affecting this dynamic. One is a trend in how software is getting built and how what digital transformation even requires. And that's a trend towards software as a service. A trend where instead of having to build everything internally, we have specialized vendors that in principle create and innovate for an entire sector. They get scale economies and they compete in quality, and then firms, large banks, and governments don't have to take on the risk of IT projects, which so often fail and can be very difficult to do in large bureaucratic in organizations. Another very closely related trend is that artificial intelligence and machine learning and other types of technology developments are finally becoming more accessible. We're seeing general purpose technology developed, as well as operationalizable best practices and all of the supporting infrastructure around implementation that's finally getting sort of non-specialized, non-tech firms to be able to use the technology more effectively. We see things like these foundation models that you read about in the newspaper that have been analyzed a lot by an institute I helped found at Stanford on human-centered artificial intelligence. These foundation models, basically what that means is that somebody with access to a lot of data and a lot of computing trains a very large artificial intelligence model. And then people can adapt it on much smaller data sets and with much easier compute. And you see these crazy things where you can type in a word and it spits back a picture or it writes an essay for you. So right now a lot of these are kind of gee whiz things you read in the newspaper, but they're starting to get more effective, and they allow even small companies to be able to use these models for prediction. So that's going to be an important trend going forward. And these examples are really just the tip of the iceberg. So overall, we're seeing trends now that finally, even though digitization is important, it's actually becoming easier and less risky to adopt. And that's good for legacy institutions and governments and central banks. But it's also important for entry. And it's enabling smaller firms to come in and have lower startup costs and an easier ability to get going. It helps people develop mobile apps with different plugins instead of having to build everything themselves and so on. These are important trends. A second issue, though, is that even though those trends reduce one kind of risk, they increase other kinds of risks, because we have now banks and institutions interacting with lots of different vendors, lots of different software as a service. They may be using algorithms that they don't even fully understand, algorithms that might be fragile, that might have biases that are hard to evaluate. And so we're introducing new kinds of risks, as well as systemic risks if everybody's using the same software and they have failures or vulnerabilities or cyber risks. So regulation is really going to need to adjust to this new reality, just to be able to do our jobs in the regular course of business, to be able to process all the data that comes along, but also to regulate firms that they're using lots of different kinds of data and lots of different kinds of vendors. Regulators are just going to need to understand data a lot more. What's the value of data? What's its use? What are the public good aspects? What kinds of data sets need to be available generally? And that also brings up the issue of cybersecurity. The cyber crime and cyber risks create a huge global tax on our economy. And we need to, there's so many public good elements and externalities involved in cybersecurity. That's another really important role. And as everything becomes digital, we become vulnerable as governments and institutions and regulators, but also we need to really understand the privacy and data sharing needed to combat both the cybercrime itself and also the ways in which cybercrime reaps rewards by exploiting vulnerabilities in our financial system and really creating the incentives for cybercrime, because if you can use information to create false identities or engage in fraud, that's the incentive behind all of that criminal activity. So these are all different areas that, new expertise that we're going to have to develop as we enter this digital world. A second area that I want to really highlight is the area of incentives, innovation incentives, and incentives to serve different kinds of customers. And part of the reason that it's hard to move money around the world is that in many cases it's not profitable to fix the problem. And that has to do with many factors, including market power. And one challenge is that regulation in financial services is often focused more on safety and security than on and incentives to make sure everyone is served. And when those trade-offs are made, it can create incentives for people to create alternatives that go around the existing system. Generally, large incumbents benefit from the status quo, and so they're not very motivated to make changes. That's not a technology problem, but a problem of business incentives, regulation, and competition. For a variety of reasons relating to customer behavior as well as relating to other economic incentives, competition has not resulted in low fees and efficient services for many categories of customers, including people wanting to send money to different parts of the world, including low-income consumers in many countries. Those segments of the market are underserved, small businesses and so on. Competition policy is sometimes effective, but in other cases, countries have gone to direct regulation, for example, the fees or fee structure, or they've targeted switching costs, or tried to create other enablers for entry and competition. Generally, though, when there are large fees on the financial rails that support the global economy, and especially if those fees are worse for smaller countries and smaller businesses, poorer consumers, that's a problem, and that's a problem that we need to be focused on, both because not solving it can create other risks, and of course that's just a part of inclusivity and global growth. The gap left over, these underserved, they can create opportunities for new businesses like cross-border payments or things that try to help customers avoid fees and so on. But regulation can actually be a barrier to entry. Now, some countries have innovated in trying to make sure that the regulatory burden is proportional to the size and stage of the business model. They've also tried to provide regulatory clarity for firms that are solving old problems in new ways. But regulatory uncertainty or high regulatory barriers can prevent that success. And when there's another problem that can occur, which is that if firms find it hard to enter and comply with regulations, you can get entrance from other types of companies that are evading regulations. And basically, if you don't provide an avenue for legitimate businesses to serve customer needs, that creates a sufficient scale to support illegitimate businesses as well. And so getting out ahead of these problems and having regulation really support entry and competition in a safe way, I think is a really crucial challenge for regulators. Finally, while creating a new technology may not be enough to overcome barriers to entry, there is something that really promotes entry into the financial sector, and that is having access to or control over large groups of consumers. And we've seen digital platforms around the world enter adjacent markets, adjacent services, like a communication platform entering adjacent services, including financial services. And if you have access to a lot of consumers locked in, it's very easy to get them to use your adjacent services through self-preferencing or exclusive access and so on. These platforms can really exert power over their adjacent services. I've done some research about this. I have a paper called Platform Annexation about how platforms annex adjacent services. So this type of going into adjacent markets or getting in between financial services companies and their customers is something that we see happening. And in some cases, the platforms are becoming new middlemen or adding additional taxes to the financial system, and something that we need to think about and keep our eye on. So when you really control a lot of consumers, that's a business opportunity. It's a business incentive. It's not necessarily about the technology you create, but it's about the control and the access to the consumers and creating bottlenecks. We're also seeing competition regulation coming into play around the world to address that concern. Generally, to respond to all of these things, the AI, the technology, the competition issues, and so on, we're seeing some regulators really trying to upskill, trying to hire technologists, to hire experts. For example, the Competition and Market Authority in the United Kingdom is one such example. But it's really a large challenge for regulators around the world to gain the capability and the expertise and to adapt quickly enough in this environment of rapid change. Thank you.
Thank you, Susan. And she brought up a lot of issues to do with the trends in new technologies, regulation, whether it's fit for purpose, also the risks that may be involved. Let's get started. I mean, we talk about new technologies, how they provide an opportunity for a new, perhaps, monetary system, but it also comes with risk. It is disruptive. How do you find that balance? How are you looking at the issue, Eddie?
Well, thank you very much. And first of all, let me join others to congratulate the birthday of Bank of Thailand. I think Susan has covered a lot of grounds. Before I cover the risk, maybe I'll talk a little about the trends as well. Susan is right in that I think AI, machine learning has become a lot more accessible, and banks are actually incorporating them into their internal operations. As AI and machine learning gets more popular, the power of data, the importance of data will actually come in. And I think it's actually important to find ways to make data accessible in a consent-based way. And that's why in Hong Kong we actually created a common data infrastructure for all banks to access as a one-stop shop. And with the consent of their customers, they can access all data related to that customer, whether it's the payments, or the company registration, or trade declarations, etc. And that makes it much more easier for the SMEs using their own digital footprint to access affordable loans from the banks. And that also levels the playing field between the bigger banks and the smaller banks, in that they have the same access to the sea of data. So I do believe that, as Susan said, AI and machine learning and the increasing use of data is one big thing that we will see in the coming years. And as the regulator or central bank, there may be a need to construct infrastructure that make it that much easier for banks to use data. But the second trend is blockchain technology, which is really coming in big. Of course, blockchain technology or innovation covers a wide spectrum. It's not really just the very speculative unbacked cryptocurrencies that we've seen having problems recently, but also stable coins, central bank digital currency, or asset tokenization. So these are trends that are very new, but I think it will come in more in the future years, and they will potentially offer benefits, including lower cost of transaction, high efficiency, or access for different customers. But of course, as with any other new innovations, there will be risks that are well covered by Susan as well, and that you mentioned. Apart from the traditional, the sort of more sort of commonly seen operational risks like cyber security, dependence on third-party service providers, operational resilience, things like that. We are seeing new risks. For example, if you increasingly use AI or machine learning for credit, there could be a risk that there will be bias in your models, discrimination against certain groups of people. This is something that we at HMA has actually issued clear circulars to banks to make sure that they can avoid those risks. And the blockchain trend, there could be even more risk. And we don't even know how to really get a good handle on some of these risks because by nature they are decentralized, it's not easy, they're crossing boundaries and they're on-chain. But we can actually start from the off-chain activities, things like regulating the virtual asset trading platform that we are doing. We will be shortly having a law in Hong Kong covering not just the AML aspect of the trading platform, but also investor protection. So if you want to establish a trading platform in Hong Kong, you need to get the right license with the right controls on your activities. The second is the investor protection part, which is about conduct regulation, and the third part is stablecoins. We are also creating another law aligning with the international consensus on regulating stablecoins if they come to Hong Kong. So there are areas that we need to have the right regulation as a foundation so that innovation can continue in a sustainable way. Otherwise, they will just go sort of quite wild.
Chung Yong, the key trends you're seeing and some of the risks involved.
Yeah. First, congratulations on the 80th birthday. For the risk, I think let me first say that I agree with you and Susan that especially during the pandemic, this technology development, AI, machine learning, all these things really changing the shape of financing market, especially in digitalization. But if I just narrowly focus on the technology, blockchain, and new technology related with crypto, stablecoin, and DeFi, I'm not so sure whether we are really seeing the benefit of this technological development recently. I was more positive before, but after seeing the Luna, Terra, now the FTX issues, I think that probably, it's already 10 years that the new technology is developed. But on the other hand, unlike the industrial revolution and IT technology, I don't know, but I'm a novice, but I don't know whether we really see the real benefit of the this new technology in at least monetary policy and the world. So I'm in line with the major conclusion of the BIS Chapter 3 of annual report that this central bank should play a more important role, and the trust cannot be outsourced and automated or decentralized. So probably, to really harness the benefit of this new technology, AI and machine learning is separate things, but distributed like technology, probably central bank should play a more role. In terms of risk and regulation, I think Sujan mentioned the reputation risk, and many private sector has quite different incentives, so it's very hard to harmonize. It's not just technology, as Sujan mentioned, it's more like harmonizing incentives, legal structure, all kinds of things. But I think incentive for the public sector is also quite different. I've never seen that the government agency try to not jumping to having a regulatory power on this industry, because they are also worrying about the uncertainties, regulation. So at least in Korea, I don't know whether it's true for other countries, the traditional regulator try to, kick the can down the road and to others. So you regulate, not me. So I think this private incentive and the public incentive difference, I think, provide the room for the regulatory gap, which may increase the risk in this transition period. My third point, I'm very happy to listen to Susan's point that the monopoly of the existing institution is a key barrier. And from an Asian's perspective, I think the best example would be the global custodian in international money transfers. So if I have time, I'm going to explain more, but I think I have a real hope that this new technology, this district technology, and what Singapore and Hong Kong is now experimenting through the mBridge and the Dunbar project, whether this new technology can actually help to avoid break this monopoly power of existing global custodian in international money movement.
The focus on safety may not be a bad thing. Risk-reward of new technologies, Adrian.
It's interesting. First of all, congratulations to the Bank of Thailand. 80 years is very young. And may you have many, many more decades ahead of independence. I'd also say that the future, actually the present now, is digital. So we have to be here, whether we were pushed or pulled to be here discussing this topic. and we have to be here to be relevant. And I'd say the risk reward, we talk about the risk of each particular digital technology or the players in the game. We have to think about the risk holistically of without them and with them. And in particular around for our ability as central banks to ensure monetary sovereignty, ensure a unit of value remains amongst everything that we're doing. And those have been under challenge, at least according to the advertising on the tin for many of these products that have arrived and some which have since departed. So, you know, we're in the room. We have to really understand the risks both with the technology available and the risk of us not moving with them, where we become less relevant or even irrelevant, and with all of the implications that can come with that. Within the Central Bank in New Zealand, you know, we're incredibly open-minded. In fact, next week we will be going through, I think it's our third consultation process with the public. Consultation is critical for all of this, in particular around continuing to earn our trust, the public trust us, to ensure that they feel there's competition, ensure that there's efficiency, but whilst maintaining that monetary sovereignty that is in there. So it's a careful balance. I'm very pleased to hear that whilst it's 10 years old, the frontier hasn't moved on too far at all. There's a little bit of fear around first mover disadvantage, I think, around moving in on regulating the technologies, but also bringing central bank digital currencies into the game. So you know, that risk reward, I think, has to be thought holistically. For us, I don't see an alternative other than to truly be open, working with whole of government around data and privacy, working with the current banks and credit allocators around the doing, and working with big technology. It has to be a very collaborative environment as we come. Speaking just from New Zealand's perspective, I mean, we stand to gain enormously. We have all of the hallmarks that Susan talked about, where you have a very concentrated, dominated banking sector, limited incentives to disrupt themselves, very few concentrated points of failure around payment and settlement systems, very high costs of cross-border transactions. So, you know, we stand to gain enormously. Not so much on the inclusion side, we're already highly inclusive, but the public themselves have told us they really want access to central bank money, whether it's in cash or electronic form, as a human right. They then also tell us they don't carry it, so getting the business case balance there is a really interesting one for us.
Before we pick up on CBDCs, Cecilia, your thoughts on the trends and the risks?
So first of all, congratulations. Coming from in my previous job, I used to work for the Swedish Central Bank, which is on its 354 years, so 8 years. Yeah, keep it going. Yeah, I see you as a very alert, very energetic teenager, out of the puberty, obviously. So congratulations on that. So first of all, I think. We should be optimistic. I mean, we just have experienced a number of years with globalization that has actually created a lot of good for millions, hundreds of millions of people coming out of poverty and increase their different choices in life. And I think the digitization forces have also, we also already see a lot of improvement in people's choices and lives. On the other hand, it's our job to kind of to worry and to think about, all right, how do we sort of design frameworks and policy and regulations and the like for the good of our societies, and this is a daunting task for sure. I think the payment methods, you alluded to that, or the difficulties of making cross-border payments is you know, we build our systems for domestic needs, working office hours. But we now find ourselves in societies where people are expecting to interact with social medias 24/7. and we stream entertainments 24/7. So obviously, the financial systems also has to deliver 24/7. And I think about ourselves, those of us who work in central banks and banks, we work in the fiat money team. And we have much more in common, actually, that divides us, and which is that we want people to stay in the fiat money system, holding money in euros, dollars, Swiss francs, and the likes. We think that is a much better place to be than being in unreliable crypto or stable coins. The technologies that is coming, that is producing cryptos and stable coins and DeFi and the likes, that might be promising, but my personal view is that what we've seen in terms of products from that world hasn't been very convincing at all. But it remains to be seen what comes from that world. Now, what can we offer? Well, we can offer an update of the fiat money system. And as the head of the BIS Innovation Hub, that's exactly what we try to produce and offer to the central banking community. So we look at these new technologies from two angles. We think about how can they change the financial systems as we know them today and disrupt them, and what do we have to be mindful of when we as central banking community conduct our objectives of providing monetary and financial stability. So that's one angle. But the other angle is also about seeing, okay, so these technologies come rolling against us. Can they actually be used to update our offers in this fiat money sphere, as I mentioned? So we get our hands dirty with different experiments, DLT, DeFi protocol, etc., and see, is this something that can actually be used for the community? And we like to showcase what could be done. But we need to leave to legislators, to executive powers of societies, and together with their central banks, respectively, to decide what should be done. I'll stop there.
Okay. As we look forward to the future of money, CBDC increasingly coming to the fore. Of course, different central banks are at different stages of embracement, so to speak, of CBDCs. Is CBDC the way forward for a more efficient system? Adi, I mean, you've looked into this in a deep way.
Yeah, I have to say yes, because we've been doing quite a few pilots on CBDC, and both wholesale and also looking into retail. But it will not be the only way forward. There are many different ways to solve problems. For example, cross-border payment by linking up instant payment system is one way. It might serve the retail sector very well. Or by private stable coins in future. It could be another way, e-wallets that can be transferred with value that can be transferred cross borders. But CBDC is actually holding a good promise in cross-border payment for wholesale use, including trade settlement. And here I thought Chang Yong just mentioned about the project amidst. It's just finished a pilot which involved 20 banks from the 4 jurisdictions which have participated: Thailand, Hong Kong, China, and also UAE, coordinated by the BIS Innovation Hub, using real-life transactions through, and the use case was trade settlement. It's gone through very well. So we're moving into the next stage, which is to look at the legal governance and policy arrangements, and hoping that it will gradually move into an MVP status with more central banks joining in. So we're really hopeful that cross-border payments using a platform like amidst can cut costs. The pilot shows that we can cut costs by half and make it much more faster, turning from days into seconds and more transparent. You know where your money is. So we're hopeful that it will proceed this way. And it also holds promise for future use cases. For example, if assets were to be tokenized increasingly in future, and if those tokenized assets were to be traded across borders, then a CBDC-based cross-border payment system will be very well fitted to be the payment infrastructure for that kind of future financial transaction. So this is one thing that we've been working on, and we are hopeful that it will proceed smoothly. But of course, the other leg of CBDC is retail. On that, it really depends on the individual circumstances of jurisdictions. There are jurisdictions that might find retail CBDC attractive for financial inclusion purposes, like Bahamas, Nigeria, where they can distribute money in a much more efficient way. There are jurisdictions that might see retail CBDC as a means to reduce systemic risk if it's dominated by a few payment system. But for Hong Kong, and I think in the same way Korea or Singapore, where we have very, very, very developed retail payment system, very diversified and efficient, we need to really think through what are the use cases for retail CBDC. We can get fully prepared. We can do the legal governance, technology preparation. But in Hong Kong, what we are doing in the next year is to really explore with different financial institutions. Show me the use case that you can find for retail CBDCs. We can even design sandbox for you to try it out. But without a proper a convincing use case, we will be a little hesitant to just roll it out for the sake of doing it, because otherwise adoption will be an issue. If nobody adopts a retail CBDC, why do you want to introduce it? So wholesale, we're moving really full speed ahead. Retail, we're testing out with the private sector.
I know in my conversation with Ravi Menon, he's talked about how there's greater value to be unlocked for wholesale, but perhaps more risk when it comes to retail. Your thoughts, Chung Yong?
Not surprisingly, we came to the same conclusion. We just finished our own pilots, which last 1.5 years recently, and then summarize some of our lessons now. But our conclusion is very similar. We see huge potential in introducing wholesale CBDC, not just for the international transaction, but even domestically. It can significantly improve the PVP, DBP system with permission DLT system. So we see enormous chance to improve the current system, introducing wholesale CBDC. As for the retail CBDC, as Eddie mentioned, since we have a really fully developed fast payment system already, and the financial inclusion is not our major objective, so the user case is not that clear. At this moment, some proponents say that there can be, the user case, since Korea has many IT companies, if we introduce retail CBDC, can expedite our IT companies to do more investment on the metaverse, the NFT, investment market kind of things. But maybe that makes sense to the young generation who spend lion's share of their daytime in cyberspace, but I may be too old to accept it right away. So I really have to think about what kind of real value it has. So, but I think we have to definitely, as you mentioned, you have to really see the real value of the private retail CBDC for the down on. But if I have some time, even for the wholesale CBDC, especially for amidst and DOMBA project, I'm more interested from a very high-level discussion of whether this can be a chance to revamp the discussion that we had after 1997 Asian financial crisis. At that time, we really think about how we're going to develop Asia capital market to recycle Asian savings. And then we try many things to develop infrastructure, such as clearing system in the region and the transaction system in the region kind of issues. But at that time, we actually hit the wall because there's a lot of harmonization, legal harmonization, technical issues to reduce the fee, which is lower than what global custodian actually charges. So in some sense, not the technology, but harmonization, legal issues, and all these incentive issues that Susan mentioned actually was a bottleneck to develop infrastructure within the region. And so that we can avoid a certain period problem. But now, given that the amidst and DOMBA project is leading this harmonization and technical development, I wonder whether this can be an opportunity to leapfrog, and then we can develop the infrastructure which we can use to promote Asia savings within the region. But having said that, I think one issue which I know that you are doing the experiment, but I have some questions because experiment is a smaller size. But how are you going to address this liquidity provider issue when you do the international transactions? For example, if some country who is participating in this wholesale CBDC want to issue huge amount of CBDC, maybe well above the reserves they have, then people are worrying about the confidence and all this, the who's going to provide the liquidity when these things happen, whether that size is relevant for the FX reserves kind of thing. So in some sense, global safety net issue coming in. So I wonder whether this can be an opportunity to combine this global safety net issue with wholesale CBDC for the international transaction. What I'm thinking is, I may be jumping to the conclusion, but I'm thinking many Asian countries not want to approach IMF or the BIS or others to ask for the liquidity service because of reputation problems during the crisis period or pre-crisis period. But this CBDC, wholesale CBDC, has a programmability abilities. So whether we can actually program those kind of things in advance so that the countries can avoid to asking these things and avoid the stigma on these things. And then, so this kind of global safety net disbursement mechanism through international organizations or the major central bank can be pre-programmed in the CBDC transaction that will address some of the issues that we have discussed after 1997. So I just wonder whether this kind of technology can allow this kind of new changes so that we can achieve the goal that we forgot for the time after 1997.
We know Powell came out to say that he wants to get it right. He's not in a hurry to be fast. Adrian, you seem to be adopting that approach as well. Why the hesitance?
I'm not sure there's a lot of first leader advantage in this. It's something that we all have to kind of get there simultaneously, as Cecilia was spot on there about upgrading fiat money version 2.0 is a part of what we're trying to do. So doing that collectively, I think, is incredibly useful. We don't want to turn up with the beta version and someone has the VHS version, and the world doesn't meet a little bit of what Chang Yong was saying. So there's that first point. The other parts are there are some really critical whole of society decisions to be made that aren't within the realm of just the central bank. So even bringing people up to speed with what are the issues and then bringing them along with where we're going is a really intensive, time-consuming task that we have. Eddie and Chang Yong are further down the path around experiments and tests. But there are some big holistic questions to be answered before we can go forward. I think it's important that we have to be technology indifferent. We need to think much at that higher level that Chang Yong was talking about. We see enormous benefit, I mentioned, around the wholesale side. The retail side, to me, the really tricky issues will be around, whilst financial inclusion is a critical goal, for some countries, they already have high levels of financial inclusion, but that means they feel comfortable at the expense of other countries who can't get access to it. In our region of the world, cross-country transfers are 40 to 70% of the GDP of some South Pacific Island nations, and having central bank technology and capability simultaneous with these other groups could be enormously advantageous. But on the other side of it, I was chatting with Governor Phil Lowe the other day around what chance has the central bank got of introducing a guaranteed privacy for use for a central bank digital currency, because that's what a lot of people are asking for. That's why they like cash. They have privacy for many different reasons, but can we really say use this, you'll get around the other laws using our own technology? It's so really complex issues that are in there beyond the technology case. Not insurmountable, but just, if we work through them methodically, I think it's important.
Cecilia?
Oh, a lot of good things has been said up here at the panel around CBDC. I share many of the observations and statements. So what I would like to kind of throw into this discussion is that we do know a lot about that the convenience value of advanced economies payment methods are pretty high. So that's why many says was the case for retail CBDC, not very convincing. Okay, I think we need to be a bit more ambitious than that and just kind of close the discussion and go home and think about what's the value of having a fiat money system. If you ask economists, they can tell you down to a kilometer how much value you get from putting up cable barriers on roads, because how much value you save in people's lives and protect them from injuries. We don't have much answers from economists when it comes to the values we have from having structured monetary systems. We don't want to come into a situation like the Europeans were suffering in the medieval times, where there were up to 500 issuers of money at the same time. And you can imagine the difficulties you had. But there must be some kind of value in between there that you should be able to capture. So if I can, we're coming up to Christmas season, if I could ask for something for a Christmas present, would be economists, microeconomists looking more into the kind of the social benefits of having fiat money system and think about, okay, do we really have to keep that going forward? If the answer is yes, then you need to have a retail CBDC somewhere along the line. I also think, so we are pretty satisfied with payment methods in the advanced economies, but I think we also need to be mindful that although the private sector is super creative, when it comes to this area, they only move for two reasons, either because of fear that someone else will take their business away, or greed, because you see profitability in moving. And here I think the public sector needs to be a bit more forceful in providing infrastructures that are open for innovation, that would take away these risks of the platform competition aspects, as Susan alluded to. We call them walled gardens in where I come from. So make sure that we take away some of the network issues and economies of scales that we actually see today. Yeah. So again, make money works, update fiat money system, and provide infrastructures that make it possible for the private sector to innovate from. And if we think that the public good value in providing it in a sort of updated form, then retail CBDCs will come down the road eventually. Different
Susan?
paces though.
Yes?
Your views, wholesale, retail, complementary when it comes to CBDCs and cash. What's the way forward?
So I think we've had a lot of good points made, and I think just stepping back to some points that were made earlier about blockchain in general, there has been a sense of a hammer looking for a nail in a lot of cases. And, there's been a lot of looking for nails. And, it turns out that one of the really big benefits of the blockchain innovation has been just that they've caused us to accelerate our innovation, but it's not always been the solution that you needed for every problem. And I think, in countries that have fast payments already and financial inclusion, I agree, like what's the use case inside the country? The cross-border payment issue has been a much bigger challenge, and I think that's someplace where there are use cases, both for consumers, but also business to business or bank to bank. And of course, part of the problem, again, with the existing system has been market power and other forces, not just technology. But if technology gives people a way around the market power and other problems, then it gets everybody, gets everybody motivated, gets everybody off their butt to try to, but both the private sector and the governments, to try to really fix these problems. So sometimes it's not the best solution, but seeing it as a solution also helps you unlock alternative solutions. I think of course, we do see bigger challenges, though, behind the scenes, and I think it's really exciting to see what's coming. Coming back, I'm sorry, one other point on retail is that the privacy issue is really big. I used to teach classes about cryptocurrency, and before anybody was really doing anything with central bank digital currency, we would have lots of discussions about the privacy issues. And of course, if you have something that doesn't give people sufficient privacy, again, that's an unmet need, and that may push people into other systems that do provide them privacy, but that maybe not your own fiat currency. And so it's a real concern that if we are offering retail products that aren't providing consumers and customers what they want, people won't stick with it, and that will create a minimum viable scale for privacy preserving alternatives.
Before we take questions, interoperability is not really the issue, regulation is. How do you get regulation right at this point?
Well, this actually relates to what Chan Yung said earlier. I do agree that technical interoperability is not really that much of an issue. The various issues that we are tackling in Enbridge, and I think has to be tackled not just in CBDC, but if you link up instant payment system, you still have to tackle these issues. Things like, who will provide liquidity, and how should you control that liquidity? Most of the time, it's really intraday or overnight that we are providing for payment purposes. Should we do the same in a CBDC platform? Those payments, at least from what's designed now, is to be done in local currencies. So who's going to provide the on-chain FX liquidity? Will there be market makers? Will there be an incentive for banks to join? And third, as you said, regulatory harmonization is really hard. There are different regulations on AML, on capital control. How do you harmonize, not harmonize, but at least pass through these barriers without unnecessarily holding back the speed of remittance, making it less efficient? So I think these are the areas that we need to sort out in thinking about cross-border payments using new technologies. And the last thing that we also need to sort out is incentives that keeps coming up. In any technology project, you need to think about what's the incentive for the intermediaries and the end users to adopt it. Let's say cross-border payment CBDC platform. Can we create some incentive for banks to actually benefit from it so that they can push that to their customers? The customers do see immediate benefits in terms of faster and cheaper payments, but how can we incentivize the intermediaries? Like Susan said, they actually benefit from the current arrangement. So I think these are the issues that we need to think through in order to make any future platform successful.
This is a really hard issue because, Eddie mentioned international aspect, but I already mentioned, but domestically, the perception of what is optimal regulation at this moment is quite different wide views. Generation has different perception. Younger generation and older generation has a completely different picture. And the bank and the IT company and payment providers have all different incentives. So to me, and also uncertainty about future technology development is quite uncertain. So we are relying on the international organization to lead us international regulatory harmonization and then follow the probably steps taken by the advanced economies. But even domestically, how to meet, in some sense have some consensus on what is the optimal framework is very hard. Compared with, I'm very happy that Bank of Korea is no longer the regulator. I see that many others regulators have a lot of headache, and I can see quite diverse incentive that Susan mentioned. Sorry, I don't have an answer.
That's a shame. I was hoping you did, Chang Yong. So, I probably start very. That's probably why we sat close together, Cecilia. Right? So very
we have
strongly.
The answer, so
that's
hear.
Right. Well, you've got the answer. I'll do another intro. I think to get regulation right is to really describe what you're trying to optimise initially, and too much of the conversation around central bank digital currencies or the technology are specific to the technology, and they're as if nothing else has changed. You've just added that. But if you step back and think about trying to have a fully trusted, where all the financial risks have been adequately identified, priced and allocated to those best able to manage, a holistic framework is critical. Otherwise, you can rule things out which actually could have diversified and reduced risk on the way through. So I think coming holistically, to do that, you have to be with the whole government and the whole community around that side. I don't think the risks actually increase or decrease. They just shift between legal, financial, operational, and reputational. These are just risks that are shifting around as new technologies come on board. So what we're hoping to do is be, as I said, technology indifferent. Make sure that the user knows that what's written on the tin is actually what is in the tin. That is no simple feat, as we've seen. People want to do it, and think about what we're trying to achieve for the whole of society when we're doing that regulation. Sorry, sounding so high level. One of our consultation papers that are out there at the moment, I think we use up 3 pages of lists of regulations and laws that need to be considered, domestic and international. But what I haven't seen is that holistic step back view. So I'm very pleased that you're doing that, Cecilia.
Okay. Thank you very much, Adrian. Well, there's a lot of great things said again, and it's hard to be the last contributor on this subject, how to get regulations right. So let me actually pose a question to Susan, but let me first just give a personal observation, which is that yes, it's hard for regulators to keep up with the private sector finding the most skilled people, and yes, it's hard to keep up with all this new stuff coming all over us and find the important things amongst all the smoke and mirrors. So I think I would like to call for the private sector to kind of step more and think about kind of code of conducts and standards, because it's really in their interest that we don't have too many casualties in this new brave world with AI and ML and DeFi and stuff. Another observation is that I think we will have a new, maybe they already exist, algorithm auditors, I think would be a future job to have. So my question to Susan, if you can hear me, is do you think do we have the right balance between the private sector and the public sector regarding regulation and oversight when it comes to, for example, ML and AI? Do you think the private sector could do more and kind of self-regulate and self-supervise? Or what would you like to see?
That's a great question, and I think there's a few different answers, actually. I think for the algorithmic auditing, it's actually very difficult for a company to audit itself. It has no credibility. And I think we've seen with more controversial topics, like, say, content moderation, it's actually kind of hard for a company to win, and everybody thinks you're being bad to them. So there can be a real benefit to companies to have third parties. We see third parties in the US around auditing credit scoring models for fairness. The regulatory framework is a bit outdated, and there's been a lot of push in the fairness and AI and ML community and in the economics community to update that regulatory framework to better address what's happening today. But in general, having sort of trusted third parties or giving some guidance to third parties and letting third parties do it is good. The research is actually not definitive right now. We don't actually have agreement on exactly what it means for an algorithm to be fair. There's different notions of fairness. There's different trade-offs, for example. Just fairness is one example that's been most studied. There are other elements of algorithms, like their fragility. And if you have a big shock, something like COVID, do they break? The machine learning community has not fully resolved those issues either. And again, that's something that needs to be done. So at Stanford, we founded this institute that was partly trying to push for research and policy papers that would help provide guidance. It's also important that stakeholders are represented, and so that's a reason to involve stakeholders outside of industry as well as industry. But industry doesn't necessarily lose if other stakeholders are involved, because again, there's some downside to being the one who's making the rules. It's a little easier if someone else makes the rules and you need to follow them, gives you some cover if things go wrong. Things like, you know, if you discover accidentally that your consumer has a gambling habit because you see it in their financial records, what's your responsibility? What should you do? Is that really something the banks should be deciding, or is that something society should be deciding? But the government needs to play, and I think governments and universities need to play an important role in framing the questions and in convening this so that we can accelerate our progress here, because our progress has really been way too slow in this. So we need more research dollars, we need convening, we need best practices that can be implemented. On some other things, I think the private sector should be contributing talent and expertise, and we just have to really guard against that regulatory capture, because we have seen things like privacy regulation or other things get co-opted in a way that really benefits big firms and makes things harder for small firms. So that's like the cautionary tale in having the firms involved.
Let's take questions from the floor, if there's any.
Thank you. Excellent panel, very interesting opinions. I mean, needless to say, I'm very pro CBDC and the decisiveness of authorities to step into this field. And I wonder if, in this respect, we're not ambitious enough as authorities, and this is a question for you. I mean, for example, you, Eddie, you mentioned, well, we have to find what is the business case for CBDC. My question is that the only answer, the only question? Shouldn't we answer other questions? For example, are we sure that completely delegating the payment system to the private sector is the right solution? I mean, we are now, you talked about incentives. You all talked about incentives, including Susan. What could be a better incentive than having the competitiveness of a central bank-centered payment system to improve the private sector? Yeah. We delegated the payment system to the private sector many decades ago. And well, the final result is for many, many years, they milk this cow until other private sectors trying to challenge it. But we're very, very concerned about protecting the industry. And we don't subject them to competition. We also should ask ourselves, what other externalities can have CBDC have? For example, for programmability, you know? Behind many of these developments of, let me put it in a simplistic way, privately led developments, there is always the put of us coming in to clean up the mess. And to really want to carry that risk forever, no? We have instances of coordination, like for payments. I mean, at the end of the day, you know, we can put some meaning to the BIS name. You know, I mean, we have settlements. We don't do much settlements today, but so we can provide some meaning to the BIS name. So I mean, I think sometimes we probably are not ambitious enough about providing a public good that can be for benefit to everything. I mean, at the end of the day, there is a public good aspect in providing trusted money, and my sense is that probably we don't step up to that challenge all the time, and we're trying to justify why remaining tame, I would say, or contained is what is leading many of our decisions. So I would like to throw this provocative thought to you, see how you react.
Well, maybe I'll start first. I actually agree that we should be progressive in thinking about the retail or common use or general use of CBDC. And that's actually why when we published our findings a few months ago, we are saying that we want to make ourselves fully prepared. So we actually will be building the technical foundation, the infrastructure that's needed, because we're thinking about a two-tier system. We're actually preparing a law so that we can do it very, very quickly. We will be doing security type of pilots to make sure that we're ready. But when we think about the rolling out, which is what we call the third rail, we need to make sure that the second rail, which is the use case, is there. The reason being that, if you think back about instant payment systems, the use case is very clear because peer-to-peer transaction payments is cumbersome, not convenient. So after we roll it out in just a few years, we've got more than 10 million registration. The use case is very clear. But for the retail CBDC, if there's no use case, we're really worried about adoption. We should be prepared, but it's not like if there's no use case, then we will not do it. It's more like ready, but hey, private sector, let's think about the use case. Is it about tokenized assets? Is it about the metaverse or NFT transactions? Or is it about, are you creative enough to suggest the use of retail CBDC in everyday transaction in place of credit cards or other payment methods? So because we're not the clean use cases, and that's actually what I meant by use case. But if in the end, after like that 1 year exploration, there's no convincing use case, we'll just wait. Maybe tokenized assets will become a lot more popular in 2 or 3 years' time. Then it might be the time to roll that out. So that's actually the way that we look at it.
Chung Yong?
I think Augustine is always modest, and I don't think the BIS is not ambitious enough. I think we got a lot of support from BIS, especially this issue is quite international. One country cannot address this issue. So what you have been doing so far is a lot of good reference for us to think about ahead, especially wholesale side too. So I think I cannot say that you are less ambitious than incumbent or even our own businesses. So I have to ask myself whether I can judge these things from a perspective of younger generation who are more familiar with technology rather than my peers. So we have to keep on asking these questions on this issue. And having said that, actually, I think I cannot more than agree with what Eddie says. When I was a little bit negative or cautious in retail CBDC, this is exactly this reason. We believe that private sector can do much better job in facing clients' need directly. And also, we have to do the pilot. But in order to do the pilot with the real terminal client, the total investment need for this pilot is huge. And after that, if the advanced economies adopt different systems, we will be in trouble, right? So we want to be more cautious in that sense. But I think, for example, like your report mentions the tokenization of the deposit. So now we are thinking about whether that can be a next step for our experiment on the retail CBDC, not just thinking about the final end users, but thinking about two-tier system. So we're going to issue the retail CBDC, and then our bank can probably tokenize the deposit and see how it goes. So we are moving step by step, but I think, let me assure you that you're not less ambitious than others.
Yeah. And I just want to say, appetite is very strong at the Reserve Bank of New Zealand. I always think starting from a position of why shouldn't we do this as opposed to why should we is a far more effective way of going forward, and with the whole holistic public good component. Because some of it is a real existential threat to fiat currencies if we aren't really being ambitious and being involved, and it is embedding incumbents and being the recipient of some very dominated, concentrated banking sectors. It's not optimal. It's just how it is, and we need to break through it. And I really love what everyone has said. Even the fear of us entering is creating enormous dialogue, challenge, efficiencies already. So whether it's switched on at the retail end or not, the fact it's ready, is very powerful. So our questions is why aren't we doing it, as opposed to why should we be doing it?
Thank you. It's interesting to listen all of this speaker. Well, the essence of central bank is to provide the medium of payment, right? In the 17th century, there's private, but later on, then central bank fiat money. What is digital currency? It's just another medium of exchange, right? So where is the role of the central bank? Then one must assurance about the digital medium of payment under the central bank. Whether you call it CBDC, you call it digital, it doesn't matter. Whether you want to tokenize, but the essence is the role of the central bank to provide the medium of payment system for the country. I think that's one thing. And the second is, of course, the providing the public infrastructure. Right? Then we're talking the demographic needs. Whether if our demographic, the infrastructure of the payment system is digitalized payment system or CBDC. Probably different in developed countries and emerging. In Indonesia, if we want to cater digitalization or inclusion with our SME do not need digital CBDC, right? What they need is QR, fast payment. For financial inclusion, the need of the central bank to provide the public infrastructure more on the digital payment system rather than CBDC. Probably on the advanced country where millennials needed a digital currency, they need digital currency. But this is where actually the role of central bank to cater the need of the customer, the society, different group of the society, they need different medium of payment system. They still need the paper money, they still need the on-piece money, but they still need digital currency. And digital currency can be delivered through digital payment system, retail digital payment, and or CBDC. I think that's the choice is different country. In Indonesia, for financial inclusion, we go to digital payment system. Much more direct need, cater the need of our SME and retail payment. Because digital currency is just used for, the new young millennial, metaverse, and so on. For the whole system, they need more on the digital payment. The third role of the central bank across border is reinventing the Bretton Woods in digital currency area. This is where a regional payment system of the ASEAN 5, where we are already agreeing on multilateral connectivity of digital payment on the QR, fast payment, local currency, and other infrastructure of the payment system. Then we have to move. We have to talk among the ASEAN 5 central bank. How is the exchange rate arrangement? How is Article 8 of the IMF? How to determine the exchange rate of the rupiah and Singapore dollar and baht through the digital currency? This is exchange rate. This is reinventing the Bretton Woods. How about capital flows management, resident, non-resident, through the digital? But of course, about the surveillance. How to surveillance of those, digital payment area or CBDC, about operational, about standardization, and so on. So the third aspect of the role of central bank across borders, reinventing the Bretton Woods in digital area. So come back again. I do not think this is about competition. Let us ask ourselves, what is the role of the central bank in digital area? One, providing the digital medium of exchange. We call it CBDC, we call it whatever, this digital medium. Second, to provide public infrastructure to cater the need of society. Some society need retail CBDC, but in Indonesia, more need is digital payment system in retail rather than CBDC. But the third is, of course, cross-border cooperation reinventing again, exchange rate arrangement, capital flows management, surveillance. Christian, you were there, and how is the role of the IMF in the digital area? Thank you.
Let's get the perspective from Raviman and his.
Thank you. Stan. Maybe instead of asking the question about whether we should issue retail CBDC, why don't we ask three other questions? How much to issue? Where does the retail CBDC fit in the money supply and monetary aggregates? And three, for what purpose? Because I think we should avoid these binary choices. I think as all of us agree, I think all our central banks are working to build up the technological, institutional, and governance infrastructure to issue retail CBDC. Is that, like Eddie and Changyong, I think that is not a compelling use case. So maybe if we ask how much we want to issue, that focuses the mind better. Today, global money supply, 8% is in notes and coins, which are direct liabilities of the central bank. 92% is in form of bank deposits. We are already in a world where the bulk of the money we use is privately issued by banks, whom we regulate tightly. In the advanced economies, I think it's probably closer to 5%. So the question is, if we issue retail CBDCs, are we seeking to replace part or all of that cash component? Because a retail CBDC is digital cash. So is that what we're trying to do? Or are we trying to replace part of bank deposits? And as Changyang pointed out very well, and Eddie as well, you can get the same programmability benefits of retail CBDC by tokenizing the deposits in the banks. And you can set up a regulatory structure to do that. And it will perform the same functions. Just as bank deposits perform the functions of money, tokenized deposits can do so with programmability. So I think those are the interesting questions that we should ask. I think all of us would probably issue it. Question is how much and where does it fit in the monetary aggregates? Because if you issue retail CBDC on top of your notes and coins and central bank reserves with the banking system, you're adding to the monetary base. So you need to think through what does it mean for money supply and money multipliers. And the transmission mechanism is very different. So we need clarity on where it fits in the monetary aggregates. Third is for what purpose? And I think there are use cases. And one way to think about it is, what is programmability going to be used for? And if you think of the notion of purpose-driven money, if I want to give money to my kids and make sure they don't buy Coke and sugary drinks and they buy good, healthy food, today I can't do that, right? Because money is fungible. Programmability means I can program that into the money. And if they operate on chain and the merchant has the same, is part of that chain, I can do that. Give a more realistic example, charities. When we give to charities, you can program, theoretically, the ultimate beneficiary receives it for specified purposes that I intend to give to charity, rather than give to the charity and not know how it is being used. The ultimate is fiscal transfers. The last 2 years, our governments have been injecting massive amounts of fiscal dollars into the system. If you want to direct it, and this is not for the central bank to decide, because we are neutral as to the use of money, we provide the medium of exchange. But if the government decides this injection of money is programmed and purpose-driven to pursue retraining, to pursue infrastructure, but not to pursue other kinds of expenditures, theoretically that can be programmed into a retail CBDC and transmitted through the banking system or to final users. So I think it'll be more fruitful if we thought of specific use cases, and we can think of specific use cases for retail CBDC. So I would submit that maybe it's more interesting to ask how much to issue, how does it figure in the monetary aggregates, and for what purpose? Then it focuses the mind rather than have an abstract discussion. Thank you.
Cecilia, you wanted to add?
All right, I'll go abstract perhaps, but I do think we have no idea about what possible use cases there is. We think we know what use cases there is today, but who knows about tomorrow and longer time in the future. I mean, look at Apple, this example is not mine, but I'll borrow it. They come out with an iPhone in 14 years ago, 15 years ago. Why did they do that? There were a lot of different mobile phone operators out there. And I'm pretty sure, but they did, and I'm pretty sure that the producers of compasses, those who did travel agency, producers of alarm clocks, producers of records, and I can go on, had no idea what was going to hit them. And that's the charm and the scary bits with the future. We don't know what it contains. So I think we should be, I'm certainly very humble about these things, but since we don't know, we need to stay alert. Eddie's approach of kind of being prepared is probably the best one to be. But we shouldn't pretend that we just because we don't see the clear use cases today in advanced economies, that is a stable situation, because it will not be stable.
Final word from Madame Lagarde.
Thank you very much. I just wanted to follow up on both Eddie and Ravi, actually, because your point is well taken, that we have the 8% of essentially banknotes, coins on the one hand, and the 92% of commercial money. But it's because we have the 8% that we have the 92%.
Yeah.
Given that it takes about, 10, 12 years to eventually come up with a product that will fly, that will be user-friendly, that will be low cost, we should get ready that in 10 years' time, your kids will simply not want to carry those banknotes and those coins. And that 8%, it might not be 8%, it might be 6%, because we will keep the 2% of banknotes and coins that some people cherish. But that 6% would have to be in CBDC. That takes a while to build.
Yeah.
Fascinating discussion, lots of questions still to be thought about. Please join me in thanking our panelists today. Thank you very much.
Thank you. Well done. Well done.
Thank you very much, all the speakers. Ladies and gentlemen, I think we have had very fruitful discussion on topics ranging from growth and inflation to digitalized monetary system. And I have to say that the afternoon session are no less exciting. Now it's about time for us to recharge our energy for upcoming afternoon session. Lunch will be served at Saman Samosan for the heads of delegates and Thai guests, which is the opposite of this room. For all delegates, lunch will be served at the foyer in front of Saman Samosan. Our BOT staff will guide you to the venue. Ladies and gentlemen, after lunch, there will be a keynote speech by Mr. Kevin Rudd on Asia in 2050 at 1:45. For now, please enjoy your lunch.
and he's a leading expert on Asia, China, as well as China-U.S. relations. And of course, he was the Prime Minister of Australia between 2007 and 2010, and also in 2013. Initially, Dr. Rudd was kind enough to try to join us in person, but due to other obligations, an unexpected assignment, he's in the U.S. right now, which is now 1:45 roughly in the morning, I think. So we pre-recorded a conversation that he did with Tao Zhang, who's the BIS Chief Representative for Asia and Pacific, and our co-host. So the conversation covers a wide range of issues, and I hope you find it interesting and useful. So thank you.
Good morning, Kevin. Welcome to the Bank of Thailand 80th anniversary conference, which is jointly hosted by Bank of Thailand and the BIS. And thank you very much for taking your time and speaking with us. I would like to begin by asking you some questions about your recent book, The Avoidable War, the dangers of a catastrophic conflict between the US and China. So in your book, you talk about a way forward for the United States and China to avoid a superpower conflict, where you focus on how to pursue a common strategic framework for the future that might be accepted by both sides to reduce the risk of catastrophes. So on Amazon, I saw there are two different versions of the book's cover page. One has a question mark after the title, The Avoidable War, and the other one does not have. So my first question now is for you, is the question mark very, very important?
Well, thank you very much for the question, and greetings to all of our friends in the Kingdom of Thailand, and congratulations to the Central Bank of Thailand on its 80th anniversary, a long tradition of Thai independence, which I'm deeply familiar with, having visited Bangkok many times. And to all of our colleagues from the Bank of International Settlements and various central bankers who have gathered in Bangkok for this important occasion. On the question you raised about the avoidable war, is it a question mark or is it not? I think everything in international politics today is a question mark. So therefore, the purpose of a question mark is to present us with alternatives. And that's where I believe the political leaderships of both China and the United States have choices to make. And the argument I outline in my book is pretty straightforward. Right now, we have strategic competition between the United States and China. Whether we want to call it that or not, that is what's unfolding. And I have a very simple approach to this, which is you could either have unmanaged strategic competition with the rolling risk of accidental crisis, conflict, and war, or you can choose, as both sides, to have managed strategic competition, that is, with certain basic rules of the road, with certain basic strategic guardrails, or what I see Xi Jinping is saying most recently in his readout from his summit with Joe Biden in Bali, constructing what he describes as an anquan, which is a security safety net underneath the relationship. And my argument at the end of the day is based on a simple logic that it's in neither country's interests at this stage to trigger an accidental war. Therefore, how do we practically find mechanisms to reduce the risk of that? And the burden of the argument is managed strategic competition is the best way forward, and the book outlines in some detail what that would mean in practice. Back to you.
Thank you, Kevin. I know the way forward, of course, the layout, a framework. Can you share with us a little bit more details how the framework will overcome the current tensions as we saw it, in the next 2 to 3 years, or even for the longer terms? How it could get involved?
Well, my argument is essentially for the next 3 to 5 years. Maybe you Chinese have trained me too well, I think in 5-year plans. But I'm looking for the short to medium term, which I define as round about 5 years. I think the first point I would make is that the idea of having managed strategic competition is not an intellectual or academic fantasy. In the days of the Cold War between the Soviet Union and the United States, after the Cuban Missile Crisis in 1962, those two superpowers evolved over time basic rules of the road, basic protocols and procedures, basic mechanisms to ensure that there were no accidental crises. And so for the subsequent 30 years, we never got to the brink of 1962 again. So I think it's important for us to bear that in mind as a precedent. Secondly, how would you go about doing it in the case of China and the United States? Well, it should be much easier because we are not yet in a Cold War. The economic engagement, as you know, and as the central bankers know well, is comprehensive between the two countries' financial systems, their economic systems, certainly their trading relationships, if no longer their financial direct investment relationships, at least as an order of magnitude. So the practicalities of it are to identify those strategic red line issues, such as Taiwan, South China Sea, East China Sea, Korean Peninsula, cyber and space, where both sides currently have their internally defined red lines. But what happens every day of the week is that these are tested in practice, and that's where you have too much metal intersecting with metal, and it can give rise, therefore, to unintended incidents. So my argument is that it's time now for both sides at the senior level, confidentially, to exchange what their irreducible strategic red lines are, so that if the other side crosses them, you know that there will be unintended consequences, or significant consequences, I should say. So therefore, argument number one is allocate time for two teams, Secretary of State, Secretary of Defense, National Security Advisor from the United States and their Chinese equivalents to construct a de minimis list of strategic red lines or guardrails within each of those 5 conflict areas. The second argument with strategic competition is through a joint framework, you could then agree that all other areas of competition should be non-lethal, namely that the rest of security policy, foreign policy, economic competition, trade, investment, technology, as well as, of course, ideology, where China offers a different set of views in terms of the future of the international system. And then finally, through managed strategic competition, you should also be able to construct sufficient political and diplomatic space for the two sides to still be able to collaborate closely in areas of global public goods. Climate change is obvious, but given the nature of your meeting in Bangkok, maintaining global financial stability is also a global public good, together with pandemic management, together with nuclear non-proliferation. So in a nutshell, that's the argument.
Great. Thank you, Kevin. I would like to actually explore more on this, but since you mentioned this part of the world, the Asian and Pacific regions, a lot of things going on, other than, of course, the in the context of the U.S.-China relations, but much more. For example, the technology advances, the transitions to green economies, and also, of course, the economic growth. So my question is, how do you see the Asian Pacific region as a whole in the futures? In other words, do you still see the realizations of the Asian centuries as we enter into the 22nd years of the after the new millennium?
Well, the two things that keep me awake at night are geopolitics, China versus US, and climate change. These I regard as two systemic challenges which have the potential to undermine not just the Indo-Pacific, the Asia-Pacific region, but the world at large in terms of fulfilling their growth and sustainability potential. Across the Indo-Pacific or the Asia-Pacific region, my argument is this: if we can manage geopolitics, then the growth trajectories of the region are still robust. Look at China, currently going through a difficult period, but still going to produce reasonable levels of growth into the future. India is rising, and we see, therefore, India's population probably the same as China's by next year, and with a new growth strategy for India emerging from the Indian government, also one which is now anchored in the principles of sustainability. Turn to Southeast Asia and you look at the emergence of Indonesia, which has registered significant growth in recent times at 6 to 7%, a country already moving towards 300 million people, and therefore also a major growth driver in Southeast Asia in the future, together with the other strong economies like Korea, like the Republic of Vietnam, our own country, Australia, etc. Put these together, they still represent a huge engine for global growth for the first half of this century and arguably beyond, if we can manage the geopolitics. If we don't manage the geopolitics and we have a war over Taiwan or anything else, war will fundamentally undermine growth. People often skip over this and they assume that war is somehow something which is over in a minute. Well, it's not, as Ukraine demonstrates, and therefore the untold economic and physical damage that would be done through a war in our region of the type we haven't seen since the Korean War, or possibly the war which ended in 1945, the Second World War. This would be catastrophic in terms of regional growth. The second challenge, of course, is what you've already touched on, which is climate change and sustainability. Here I've got to say that the Asia-Pacific has been slow. China, a decade ago, was not doing much. China is now doing quite a lot. And there has been a sea change in China's strategy, though all of us want China to do more, currently as the world's largest emitter. The country we're most worried about, apart from China, is India, where the decision to move towards sustainability has been late, and the transformation of their coal-fired capabilities to renewables has been slow, although Prime Minister Modi has indicated an accelerated timetable for doing that. When I look at Indonesia, it is also slow, although there have been encouraging signs coming out of President Widodo at the Bali G20 summit recently concluded. And the other major economies of the region, Australia, Japan, and Korea, need to lift their game. You see, between us, these economies that I've just mentioned, by the time we get towards mid-century, we will, between us, represent more than half of global emissions. And that leaves out the United States and leaves out the Europeans. So, President of the Asia Society, I chair an independent commission on getting Asia to net zero. We've done a report already of econometric modelling on India doing that. We've just done one on Indonesia doing that. We'll be doing one on China soon. And what our argument is that this transition, if executed effectively over the next 5 to 7 years, can be done with enormous upside for the economy and while still managing the transition costs. I think they're the two big challenges and alternatives and opportunities for the Asia-Pacific region for the first half of this century.
Well, that is very clear in terms of what is the future challenges as you just outlined. If we pull back a little bit, just look at what happened in the last few decades. This region, the Asia and the Pacific region, has tremendously benefited from opening up and economic and financial interconnectedness, both within the regions and with the rest of the world. So, in your observation now, do you see that the globalization is in retreat or reshaping? and of course how the opening up and international interconnectedness can be more beneficial to this region, and of course to the entire world as well on a more sustainable footing. Here, of course, particular point because I come from the international organizations, the BIS I'm currently work with. So my particular concern or interest is how these multilateral institutions can do a better job in terms of supporting the multilateralism.
As for the future of globalization, as we all know and as central bankers fully understand, the enormous economic dividend of economic globalization is there for us all to see. Really, over the last 30 years since the end of the Cold War, globalization has contributed to unprecedented economic development, lifting so many people out of poverty. Look at China itself, and look at what's happening now in India and Southeast Asia. That the benefits of globalization, the opening up of new trade markets, the opening up of new investment flows, the opening up of capital markets, the emergence of dynamic venture capital industries, for example, to capitalize on the new technologies. This is writing a brand new chapter in the history of global economic growth. When we look at the whole spectrum of international economic history, at least over the last 500 years. Now, of course, our old friend geopolitics comes back, and geopolitics, regrettably, is launching a torpedo at the globalization project. It may not kill globalization, but it is slowing it down. Secondly, it also may produce two globalizations. You may have 中国式的全球化 Chinese-style globalization, and you may have 美国式的全球化 American-style globalization, each anchored in its own currency, perhaps over time. When I look at Chinese-style globalization, look very carefully at the rollout of digital commerce and digital finance and digital exchange through China and in particular the Belt and Road Initiative countries right across the world. There you can begin to see a pattern of, shall we say, globalized activity occurring within that framework. But increasingly, it's being separated from the rest of the world, anchored in, shall we say, American classical forms of globalization anchored in the US dollar. Now, these trends are only just beginning. They could become much more accelerated, and we end up with these two polarizing globalization concepts. And that's where globalization ceases to be truly globalization. Again, the ultimate solution lies in geopolitics. And unless we can manage strategic competition between the two majors, the US and China, then I regret we'll either have two forms of globalization or we'll have a retreat to economic nationalism, which is even worse, and return to various forms of economic autarky. The cry in all countries, including in China itself, to secure our national supply chains for national security purposes is now heard in every country in the world, including, I've got to say, when I read Xi Jinping's report to the 20th Party Congress, as well as in regular statements in the United States Congress, as well as statements in every country in the world. So globalization very much is at the crossroads.
Well, thank you. Yeah, I understand you outlined the globalization could be in the different forms or even have two types of the globalizations running on its own footing. But even that can be the case, and how sustainable that would be, because as we see it, globalization is a cross-border movement. And so if indeed there's two systems to separate globalizations, take their own course, how these two courses could interact and how the rest of the world, other than the United States and China, would participate into these two simultaneously running globalization?
Well, there are two strategic alternatives and probably three. I hinted at them before. One is through huge effort in overcoming geopolitics, we sustain a single globalization project, albeit a reformed one, because it's got to take into account various inequalities, as well as taking into account ESG and in particular sustainability. The second alternative is the one we are beginning to default towards, which is these two competing sets of globalizations, which I don't think will produce the same level of global growth or good outcomes for the planet. And the third is even worse, which is a retreat, as I said, to various forms of national self-reliance and almost autarky driven by protectionism. My argument would be that the time has come for the international institutions to actually rise to the challenge here. National political constituencies will always answer to their national voter base or electoral base. In the case of the Communist Party, its membership base. But the bottom line is international institutions are brought into being to manage the global commons, whether it's the World Trade Organization, whether it's International Monetary Fund, whether it's the World Bank, or whether it is also other institutions such as the G20 or the UN Framework Convention on Climate Change. You see, these institutions, in my argument, now need to speak with their own voice. I know they're constructed by national governments. I've been in the business of national political life myself, and I've worked with these institutions over a long period of time. But the world needs the voices of multilateralism, of globalization, as well as arguments in favor of managing the global public good, because the national voices addressed to that are becoming quieter. Let me give you one classic example, which goes beyond the remit of the central banks. But let's look at the future of global trade. The truth is, global trade has not been growing as rapidly as it has in the past. And in some stages, we have seen contraction, albeit induced by crises such as the pandemic. The World Trade Organization, to be blunt, has been quite silent in this, and it's almost become ineffective in discharging its mandate. Now, the WTO will say that's the problem of national member states. That's an argument. But it now requires bold leadership by the heads of these institutions, IMF, WTO, the rotating presidency of the G20, as well as the World Bank, to reclaim the ground for globalization with the argument, the logic, and the advantages to be delivered by it. Back to you.
Thank you, Kevin. That's very thoughtful. And of course, thank you so much for sharing with us your insight and all of these wonderful analysis. All of these will be shared with my colleagues at the central banks and of course BIS. So with that, we talk quite a bit about the geopolitical tensions in our conversation today. So one question, of course, from my colleagues at the central banks or BIS to you might be, what can central banks do with their defined mandate, of course, to help cushion the spillovers from the geopolitical tensions on the national, regional, and global economies, in a sense that the central banks as a whole, particularly for example, the BIS as the bank work for these central banks, how we can better perform or work to provide the international public goods as you just described.
Well, the great advantage of the central banks, and again, I extend my greetings to all of you gathered in Bangkok, is you all speak the same language. You all speak the common language, not just of economics, but you also speak the language of financial economics. And there is something about the language of economics and the language of financial economics is that it actually transcends nationalism because it speaks to a common global economic logic. Unfortunately, geopolitics is not like that. Geopolitics, the language of geopolitics is invariably national. And as a consequence, it's limited in its ability to deal with the challenges of globalization. Secondly, for the central banks in particular, you have a great mandate in terms of warning. 警告 is the Chinese word. And I remember this carefully from the global financial crisis of 2008, 2009. The central banks have a central responsibility to warn the global political class when we see the evidence of an emerging global systemic financial crisis. The political leadership of our various countries will not be attuned to that. The central bankers, always one step removed from central politics, will have their fingers on the pulse in terms of any emerging systemic financial risk. Of course, you know that as a result of the global financial crisis, we established the Financial Stability Board. And we know that the Financial Stability Board also works with the Basel Committee, and I'm sure with the Bank of International Settlements as well. The purpose behind our decision to establish the FSB, built on the original FSC, was that we wanted the central banks and the central, shall we say, finance institutions of the world from the major economies to be able to do two things: warn us of emerging crises. Secondly, advise us as to what should be done to head those crises off. And thirdly, to put in place various measures to prevent such crises, such as we did with the whole raft of reforms brought in by the FSB, from capital adequacy ratios through to too big to fail to the rest. This is an important continuing slab of work. My last point would be for central banks is that everyone's statute establishing each one another's central banks will differ, but often they have a mandate in terms of maintaining full employment or ensuring manageable low inflation in terms of overall macroeconomic stability. In other words, to sustain growth and employment, or to slay the inflationary demon when it emerges. Now, for a lot of the last 20 or 30 years, when the banks have been called upon, it's usually been inflationary. How do we enhance demand to deal with crises which have emerged by one reason or another, which have depressed global demand, increased unemployment, such as what happened during the GFC. Now, of course, we have the reverse challenge, the global inflationary challenge. Therefore, the challenge now, of course, is to defeat the inflationary beast, because we know too well the history of the 70s and the 80s to ever want to return to that again. But as you know, as central bank professionals, it's having these three disciplines in mind: keeping inflation under control, because the political class will never be able to do that effectively, whatever they may say about their fiscal disciplinary intentions. Second, ensuring that when downturns occur, that demand around the world is sustained through appropriate Keynesian measures, But thirdly, to also keep a razor-sharp lens on systemic financial stability. I argue that is a continuing global good, which should form part of the US-China relationship in the future as well, given that global financial instability would be devastating for both.
Great, wonderful, Kevin. I wish we could continue our conversations, but I realized that I am running out of your time today. So thank you once again for talking with us. And we're looking forward to welcoming you again in future occasions. Thank you.
Look forward very much to doing so. And I'm sorry I can't be with you Bangkok in the flesh on this occasion, but I'm sure we'll catch up again soon. Goodbye now.
Bye-bye.
Ladies and gentlemen, next we will have a coffee break before we proceed to the last session of today. Again, the coffee break is served in front of this room. Enjoy your break and please kindly return to Pathara Rwom Jai at 2:45.
Welcome back, ladies and gentlemen. I hope you all enjoy the afternoon break. We are now coming to the last session of today's event, with the topic, the myths and realities of the roles of central banks in combating climate change. Please join me to welcome Mr. Ravi Menon, the Managing Director of Monetary Authority of Singapore and Chair of Network for Greening the Financial System, to share this session. Please also join me to welcome the lead-off speaker, Mr. François Villero de Gallo, the Governor of the Bank of France, who virtually joins us. Now, I would like to introduce all panelists in this session. Ms. Noor Shamsia Mohad Yunus, the Governor of the Bank Negara Malaysia. Dr. Ma Jun, the Chairman of Green Finance Committee of the China Society for Finance and Banking, who joins us virtually. And lastly, Mr. Ian Kose, the Acting Vice President, Director of Prospect Group and Chief Economist, Equity, Growth, Finance and Institution-Wide Presidency from the World Bank Group. Mr. Menon, the floor is yours.
Thank you. And welcome back for the third and last panel for this conference today. First off, let me also join the others in wishing the Bank of Thailand happy birthday, happy 80th birthday. If compared to the Swedish Riksbank, you're a young adult, I dread to think what the MAS, the Monetary Authority of Singapore, at just 50 years old, we must be like an immature teenager. But we're all on this learning journey of central banking. There's no shortage of new things to learn. And 5 years ago, definitely 10 years ago, I don't think we would have had a panel discussion on this topic. So it just shows how much the world around us has been changing, and we need to keep in touch. The introductions have already been made. We're very delighted to have François Villero de Gallo, the Governor of the Banque de France, who's with us virtually. He'll lead off our panel with some opening remarks and an interesting set of slides. And then we'll have our distinguished panelists, Noor Shamsia, Dr. Ma Chun, and Ian Kose to respond. And then we'll have a free-flowing discussion, which I hope you can join us in the course of time. Let me, before I turn over to François, just make some very broad context-setting remarks. One is temperature, 2, carbon, 3 is risk, and 4, so what do we central banks and regulators do about it? Temperature, it's always important to remind ourselves that to avoid catastrophic and irreversible climate change, we need to limit global warming to 1.5 degrees Celsius above pre-industrial levels. And that science is becoming more and more substantiated. And those models are being proven more and more correct. We are already at 1.1 degrees Celsius above pre-industrial levels, and the temperatures are still rising. It is quite likely that within the next 10 years, we will cross 1.5 degrees Celsius. And the challenge for the world is then to bring it back down from above 2% back to 1.5 degrees Celsius before 2050. So we are already in quite a dire situation, and it's not surprising, which leads me to my second issue, carbon. To reach this temperature target, we need to achieve net zero carbon emissions, or more accurately, greenhouse gas emissions, which includes methane and other harmful substances, to net zero, meaning the amount of carbon we take out from the atmosphere must equal what we put in. It's a very ambitious target, but that's what the science is telling us needs to be done to cap global warming and avoid catastrophic climate change. So that's another number to bear in mind, net zero by 2050, which means by 2030, which is just 8 years away, we would need to bring down carbon emissions by 45% relative to 2010 levels. 45%. And guess what? Carbon emissions are still rising, which means that's another target we are most likely to miss unless very drastic action is taken. So according to the UN's emission gaps report, on our current trajectory, assuming that we fulfill all our commitments, the national NDCs and the private sector's commitments, we would still be 55% below the emissions target for 2030. So this is a really serious situation. If I may add, long after the problems of war, pandemic, and inflation are behind us, the climate crisis will still be with us. And I think at the 90th birthday of the Bank of Thailand, when we gather here again, I think we will still be discussing this topic. Risk. So what does this mean? It poses severe physical risk and transition risk. The physical risk is already happening. Yep. You just have to look at Pakistan and look across Asia, Europe, the drought, heat waves, Australia, and North America aridification. It'll affect global GDP significantly. The Network for Greening the Financial System, the NGFS, has done 6 scenarios which try to show the trajectory of how global GDP is going to be affected by the physical change coming from the climate. It'll also have an impact on inflation because food supply is going to be affected, agricultural yields will plummet, and the cost of food may have to go up. Transition risks. To avoid this fate, the world will have to make major adjustments, principally in how it produces energy. And so the shift to clean energy will have its own set of transition risks, which are different from the physical risks. This will, at least in the short to medium term, probably mean higher inflation. And Francois is going to touch on this phenomenon of greenflation as we make the switch to cleaner energy. It also means not just energy. It means a change in the way all sectors of the economy produce goods. To reach net zero means a structural change in the global economy in every sector on the scale of the Industrial Revolution. It's going to be as big an economic and societal change as the Industrial Revolution. And we know the Industrial Revolution, for all the great things it produced for us, was a very challenging transition. And those transition risks will have to be borne and will have to be managed. So these are important questions for us as central banks, which leads me to the last set of questions, and that's a nice segue into inviting Francois to come in. So what do central banks and regulators do about it? At the minimum, we need to look at the risks of both transition and physical, what it means for the financial system, what it means for the balance sheets of banks, insurance companies, asset managers, and so on, and how do we prepare and manage those risks. At a minimum, there's already a very important role for central banks and regulators. Then the other question that we may want to ask ourselves, to the extent that the financial sector can help to solve or contribute or enable solutions to the transition, is there an additional role for central banks and regulators to lean in to support and facilitate the financing flows that are necessary? And how can we do that in a way that does not compromise our core mandate, and yet understanding the severity and urgency of the situation, what can we do? Because today, according to various estimates, to take McKinsey for example, the world needs annually $9.7 trillion of investment in transition. Every year, $9.7 trillion. Today, we're only doing about $5.8 trillion. So there's a shortage of about 35%. How is the financial system going to level up to provide this additional funding in a way that is responsible, that is safe, and yet contributes to the greening of the economy? And what can central banks and regulators do on that score? So that's just by way of introductory remarks. Now we'll turn over to Francois, who will share his insights and wisdoms with us on his take on some of these issues. Over to you, Francois.
Thank you very much, Ravi. I couldn't agree more with your introductory remarks, your alert and your call for action. I would also like to join you complimenting Bank of Thailand for this 80th birthday. Dear Setaput, it's very impressive. Your bank is older than I am, but younger than my mother, whom I could see yesterday evening, and my mother is in excellent shape, so congratulations. In this lead of speak, I would like briefly to concentrate on what I would call the macroeconomy of climate. And there are scenarios, questions, and these are preliminary thoughts about its consequences on monetary policy. Let me go quickly through some slides. If I can, sorry, I went this way. First, to remind you that thanks to Ravi as chair and to the Global Secretariat of the NGFS, which is based in the Banque de France in Paris, we published in September 6 macro-financial scenarios. I will not enter into details. They are consistent with the IPCC physical scenarios, but perhaps two conclusions. First is that the sooner the transition would start, the more orderly it would be. It seems obvious, but it will not be obvious in our democracies. We need time consistency. Transition will be a long journey, and democracy has a short time horizon, so we should really be continuous. And second, that it's very important for central banks to start research and analysis on the macroeconomic part of climate action. We are still a bit late in that field. If I look at the ECB, we are really pioneers in greening our operations, greening our disclosure. We will come back to that. But we are only starting on the macroeconomic analysis. I will go very quickly through this slide about the main results of NGFS simulations. I took here only 3 scenarios: delayed transition in blue, current policies, which is the worst one, in green, and net zero 2050 in dark. You can see that current policies lead to an economic catastrophe by the end of the century, with a possible loss of GDP of about 20%. And if we look at inflation, delayed transition is a quite bumpy road. Net zero would start with greenflation, you mentioned it, but it would stabilize quite quickly. These are only scenarios. These are scenarios because there are many questions, as you can see on this slide. And we try to have very simply 2 axes, one on output and one on inflation, and 4 possible panels. One word, unfortunately, about the top left panel. It's in gray, and it's more or less what we are experiencing with Ukraine. It's a scenario of stagflation, so upside in upwards inflation and downwards growth. It's too early to tell where we will be. I will illustrate in the following slide. But let me probably say that first, inflation is going to be more volatile and less predictable. Second, spelled here, that the phasing and continuity, I repeat it, of climate transition policies will be key. May I perhaps add that the plausibility or probability of each of these 4 panels is not the same, and possibly negative output would be associated with the transition, and possibly also higher inflation, not for sure, but possibly several tenths of percentage points on a yearly basis. Which leads me to some illustrations. We took some scenarios for France. We wrote short terms because this is on the horizontal axis a number of quarters. So 20 quarters equals 5 years. You have each time in red inflation and in blue growth. And each of the 4 scenarios is a traduction of the 4 panels you just saw. I won't comment in detail. Obviously, the picture on the right is much more friendly, so to say, than the picture on the left. Let me perhaps only elaborate on the top left, where we would have a sudden increase of carbon taxation due to a disorderly transition, an increase of carbon taxation by $400 a ton with a very significant effect on inflation. As you can see here, it would be more than 1.5% for a short while. But uncertainty on the bottom left also has a significant economic cost. This brings me to some preliminary thoughts on monetary policy. In the textbook, we should look through if these 3 conditions are met. But probably they are not, especially condition B. And if I can put it with a smile, this is more or less what we thought collectively, central banks, 1 year ago, about the first supply shock of the COVID recovery. And we had to adapt our monetary policy quite quickly. We have other ways of reacting than focusing only on core inflation and looking through. But let me perhaps sum up with 3 simple convictions. First, we have no choice but incorporating climate change in public policies, including in monetary policy. If we ignore climate change, it will be a catastrophe, as you said. Second, the transition might be inflationary and even slightly stagflationary. I stress the might. We don't know yet. But for sure, it's more costly if it's delayed and disorderly. And third, for monetary policy, looking through is or would be a seductive monetary policy strategy, but it's probably a risky one. So we will have to react, but not to overreact. And in this field, more than ever, the monetary fiscal mix is a key condition of success. It's easier said than done, but we'll see. If I come to my conclusion, let me illustrate perhaps the topic of our panel with 2 last brief slides. We like to sum up our possible levers as central banks on climate change with these 2 axes. On the horizontal one, as central bank, we have monetary policy on the right and non-monetary portfolios on the left. And as supervisors, and most of us, I don't come yet to the following, if I may, as supervisors, the vertical axis, we should look at risk, and this is the question of disclosure and stress test. I will illustrate, but also, and you mentioned it, how can we develop opportunities of green finance? And I come to my last slide, which has these 2 parts of monetary policy and supervision of risk. On the horizontal axis, I won't elaborate more, but we have this question of transparency and operations. I insist on the left part, which is models and macroeconomy. I try to illustrate. On the vertical axis, as supervisors, we are making quick progress. You mentioned, Ravi, disclosure, and it will become mandatory, at least in Europe and hopefully worldwide. And I know that many of us are active in that field. The other progress I would like to welcome is the development of stress tests, which is not only the snapshot, but so to say, forward-looking, the video of risk. We were, let me conclude with that. We were nowhere on climate stress test 4 years ago. Thanks to the NGFS, to its scenario, to many other inputs, we have now more than 35 jurisdictions considering stress test. It's not yet perfect. And we have been running in France the first climate stress test in 2021. but learning by doing is very promising, and I believe we have a toolkit to act, which is now a right answer to your call for action. I will stop there.
Thank you. Thank you, Francois. It's provided us a very good framework to help us think about the issues. Very wisely, Francois is not making predictions because we do not know what's in the future, but I think he's presented us a very good framework to think about what might happen and how we go about analyzing this. Made very interesting observations about the upside and downside potential on inflation, and I think this is something that I'd like to hear comments from our subsequent speakers. So maybe with that, I'll turn over to Shamsia to respond to what Francois said and to add on.
Right.
Shamsia, please.
Right. Thank you, Ravi. I also like to take this opportunity to congratulate Bank of Thailand for your 80th anniversary. As the big brother or sister to many of us here, there is tremendous respect, and we have learned a lot from you. So congratulations again. So yes, Francois, I totally agree with a lot of the points that you have touched on in your presentation. And I'm going to echo some of the general challenges that we see in this journey towards a net zero. First is, we are going to see a further rise, like what you said, in the global prices of key metals and minerals in coming years as the demand for renewables surges and the supply remains tight, especially under a net zero by 2050 scenario. So far, what we have seen is the impact on consumer price inflation from these demand-supply imbalances in these key minerals has been quite limited. But like what you said, Francois, there is a great deal of uncertainty with respect to the trajectory in terms of demand, supply, prices, and also technology trajectories that would make it very difficult for us to see whether some of these demand imbalances, these price pressures, is going to be persistent or is going to be transitory, and how entrenched it will be, which could, from our mandate, would lead to a much more broad-based price increases. And there is also, like what you said, Francois, the risk for the monetary policy transmission channels to be impaired should the transition process becomes delayed or disorderly. And the use of carbon pricing, while it may nudge transition, but it also may add into the inflationary expectation. So there's a lot of communication that needs to be done by the government, especially as how the carbon pricing would pan out and how then it will affect inflationary expectations of the households and the businesses. So the other thing that, and another added challenge from an emerging market is that when it comes to the green technologies, the advanced economies would be driving the technology innovation, but the emerging countries would most probably be the manufacturers, of this technology. So this adds greater disparity with respect to the economic complexity. So these are some of the other challenges, Francois, that, as a central bank, in order for us to maintain our credibility, in order for us to be able to manage inflationary challenges, that preserving our credibility in managing the transition and anchoring inflationary expectation is going to be much more challenging in a period where it's very difficult for us to really predict what will happen and what would be the path with respect to demand, supply, and like I said, technology and all the things that comes with it. So I think I will stop there.
Thank you, Shamsia. We'll now move over to Machin from the People's Bank of China. Machin, please.
Yes, well, let me also start by thanking BIS and the Bank of Thailand for inviting me to join this conversation, and thanks, Ravi, for hosting. Now, I'd like to touch upon this issue from the recent document that G20 Sustainable Finance Working Group has produced, which is called the G20 Transition Finance Framework. I think this framework is very important, as in the past years, many of us in the G20 discussion group have realized that the pure green activities are only part of the object that we need to finance. And a larger amount of economic activities, including those in carbon-intensive sectors, such as steel, cement, non-ferrous metal, transportation, paper, textile, and so on. They are carbon-intensive, but they need to move towards net zero. And in this process, we need to finance their transition. And in fact, I plotted a chart showing that the amount of potential financing that's needed for transition is actually much larger than those pure green activities, which could take the example of renewable energy and electric vehicles. And that's why a framework is needed to enable the financial institutions to identify transition activities, to disclose transition-related information, to develop financial products that's suitable for certain transition activities, and also to incentivize these activities so that we can make them more bankable. That's why this document, which was approved by the G20 Leaders Summit in Bali back about 2 weeks ago, I think is very important, and I encourage all of us to be taking a good look at that and think about how to translate this framework into actual policies and regulations and guidelines from the central bank and supervisors.
Thank you. Thank you, Machun. I think both Machun and Shamsia have brought up an important point, which is about the importance of transition finance, not just green finance. If you take a rather overly simplistic view of de-risking from high carbon emitting sectors and investing in green, that's not going to get the world to net zero, because only 8% of the global economy is pure green, as in clean energy, solar, and wind. The bulk of the economy is right in the middle. You take steel, plastic, cement, and ammonia. Together, they account for 17% of global carbon emissions. We can't do without these things. And yet, they are high carbon emitting. And we need to find ways to finance them in a way that incentivizes them to bring down that carbon content. How you get them to decarbonize. This is transition finance. And in Asia especially, it's a big problem and a challenge. And I want to come back to this, but maybe we'll hear from Ian Kose first, and then we'll come back to this issue. Ian, please.
Thank you. Thank you, Ravi. Let me also congratulate the Bank of Thailand on this wonderful birthday, and Bank of Thailand and the BIS putting together a very strong program. Francois's presentation was short, but it was a very rich, loaded presentation. I'm going to make 2 quick points in response to that presentation. The first one is about the question, should monetary policy look through greenflation shocks, as Francois put it? He showed us a very simple categorization of climate shocks to think through how monetary policy can react to them. And it's very important that, these shocks, especially the negative supply shocks that basically translate into stagflation, something we need to focus on. Here, the big challenge is that some of these shocks are not necessarily transitory in the context of climate change, but they can be highly persistent. And they can come from different sources, and they can take place at different times. Of course, these shocks can be associated with the energy sector, can stem from labor markets, can be associated with supply disruptions, and can take place in different countries at different times. Francois alluded it a little bit. This is exactly what happened during the past 2 years. We have experienced a series of supply shocks, and inflation turned out to be more persistent than what we thought 18 months ago. And I think in the context of climate space, this could be a magnified problem for central bankers to deal with. Now, the likelihood of a series of highly persistent negative shocks on the supply side cannot be underestimated when we are discussing, of course, the climate challenge. If that happens, there's a possibility that economic agents will expect higher inflation, not just in the short term, but also in the medium term and the long term. So Francois basically assumed that actually inflation expectations are anchored in the long term. But when you have a series of supply shocks, there is a possibility that you cannot simply think that these agents are going to consider that this inflation is going to be anchored at the target central bank would like to have. Now, that's a huge challenge, and the implication is that a central bank might have to reassess its monetary policy framework and or its inflation target. Madame Lagarde already alluded to that issue in the morning in the context of the types of challenges we are going through now. And of course, Francois simplified the problem, and I think his logic is right on target, whether we should think about the core inflation or the headline inflation. But in the context of climate change, when you have persistent supply shocks, the issue is much broader than that, and it requires the type of exercises Francois showed us, and it requires much more thinking. The second point is these NGFS scenarios, and great thanks to Ravi and Francois, of course, leading this effort. These scenarios are very comprehensive, very useful, done using a wide range of models and very disciplined. Unfortunately, they are not good if you would like to sleep, because they really clearly show the very serious costs associated with materialization of physical risks. And these risks tend to be much larger than transition risks. One important observation is that GDP losses stemming from the materialization of physical risks is much, much larger for emerging market developing economies than advanced economies. For countries in sub-Saharan Africa, in Latin America, in South Asia, including in some countries actually in this region, in East Asia, these costs are very large. Wherever you are in a tropical zone, the costs associated with the materialization of physical risk very large. The bottom line is that we need to look at the implications for inflation beyond, growth and, of course, financial stability, as Francois did in the context of France, taking these NGFS scenarios and assessing what types of monetary policy challenges these types of shocks will lead to, and get ready given the kind of the picture Ravi described at the beginning of the session. I will talk about these issues as we move along, but let me stop there, Ravi. Thank you.
Thank you, Ian. Thank you very much. We've got quite a set of issues. Let's try to unpack them. Maybe start with what's core to a mandate, inflation. I think Francois gave the correct answer that we cannot know for sure whether it is going to lead to higher inflation or not. But let's probe that a little bit more, and I'm going to invite Francois to respond to what Ian just said, which would suggest that this is in the nature of a series of supply shocks, and it is of a persistent nature over time. If I may give an analogy, the world enjoyed a large, persistent negative price shock with the entry of China into the global economy. It did not happen in 1 year. The entry into the WTO and China's opening up happened over a short span of time. But the effects of that on global production, on global supply chains, global inflation, was over 2 decades. And the world enjoyed that windfall. And now, of course, we are looking at that coming to an end. Isn't climate change, the transition issues, of a similar nature? It's not as if the whole world is going to adopt electric vehicles or green energy over 2-3 years. The world is going to do this over 10, 15, 20 years. Of course, the technology cost curves will come down. But at least in the short to medium term, it must mean, and I'm putting this as a provocative question, higher inflation. How would you respond, Francois?
No, I would fully agree, dear Ravi, with your first sentence. The right answer is we don't know yet, but we must be alert. Perhaps to share 3 thoughts complementing what I said and what you just said and trying to answer your provocative questions. First, I am quite impressed by the magnitude of estimates we have on this greenflation. And in some scenarios, it could be more than 1% a year, which would be very significant. But most scenarios tell us that the magnitude is probably significantly smaller than that. I would say between 0 and 0.5 on a yearly average. And again, an average is not very significant because, as I showed, it will be very time dependent. But if I had, among many scenarios, to try to give a probability, probably we will have some greenflation, but smaller than quite often mentioned in the past. I would say some 10th of percentage point. Not for sure, but this would be my guess or my bet. Second, we should be quite transparent about the macroeconomy of climate. We have, as you are probably aware, this debate in Europe. And there were forecasts by some European institutions quite optimistic about the fact that it would perhaps bring a positive growth shock. It would have no detrimental effect. I don't think it will be very negative, as said earlier, but we should be transparent about the fact that possibly it might have negative economic effects, be it on output or inflation. But the worst economic scenario is if we don't run the transition. This must be for clear. If I take the French example, a renowned economist, Jean Pisani-Ferry, just published some figures about the truth of the transition. I think it's useful in our democracies because the policy case for fighting climate change is obvious. And third, and this will be my last remark, and I found your parallel with the Chinese entry or development in the world economy, and Chamon is going to comment about that. I think it will be a long transition. I agree with that. And here again, the more predictable and consistent in 2 or 3 decades this transition will be, the more welcome its economic effects. There are many debates about the level of carbon price, the kind of tools we should use, etc. But if I had to have a provocative remark on my side, obviously these tools are important. But the predictability and consistency of the tools, whatever they are, is still more important. So we have to coordinate across jurisdictions at international level, and we have to coordinate through the next decades. This is probably the most difficult challenge, but I hope the most promising one.
Thank you. Excellent. As always, a very wise and balanced response. I think it highlights the complexities of the issues. I'm going to ask Shamsia and Ayan also to respond to the inflation part. I thought there were 2 points that Francois made that were important. One is that the estimates so far, there's a wide variance of those impact assessments. And I was just minded that while the MAS's own results are closer to the Banque de France, the Bank of England's estimates, when it did its stress test, was that in an orderly transition, inflation will go up by 0.6 percentage points by 2030, and in a disorderly transition by as much as 2 percentage points. So it shows the variability. But I think it underscores an important point that Francois made. The longer you delay the transition, the higher the impact on inflation. And that's what I think all our stress tests are showing, that if you delay the transition, the impact on output, negative impact on output, and the impact on inflation is going to be bigger because you are compressing the transition in a shorter span of time. And I think that's what the Bank of England stress test is showing. Shamsia.
Yep. I think on this, like I said, there's a lot of uncertainties. Like, Francois, you could keep up underlining, could be, it could be. So there are many, many paths that, how this, our journey, our respective journey to the net zero would be. And managing the transition is going to be very important. For example, weaning off fossil fuels, it's not going to be easy from where we are, what we need to do, and where we need to go. So, and for some, if the transition becomes protected, it will result in, some of the scenarios or the events that you had said. So, communicating on the nature, the impact, and the transmission of this to the economy is very important to anchor inflationary expectation, and more importantly, for us to prevent wage price spirals. So, and that's where I see the big challenges in emerging countries, especially in managing the transition, because not only we have to make sure that inflationary expectations becomes anchored in the face of a lot of these uncertainties, but in emerging countries, there's also the other added challenge of how do we ensure that the transition does not result in what we call financial exclusion, and especially in emerging countries where SMEs, account for. In Malaysia, for example, 98% of our enterprises are SMEs. So managing this transition, having this transitional finance, and more importantly, the know-how. So when we talk about, the SMEs, yes, they are aware the need to adopt more sustainable practices in order for them to be more viable in the longer term. But, what they often struggle with is how do I get there? And that's where, so what kind of infrastructure, what kind of measures that a country needs to adopt together with the financial institutions to provide this know-how in a manner that will help the SMEs transition. So for us, we are experimenting with this. We have recently set up a fund, or what we call greening the value chain for the SMEs, where the banks are supposed to help the SMEs measure and reduce their GHG emission. So for me, that's the other added dimension that emerging countries needs to struggle with, because like it or not, we don't have the liberty to chart our own path. We don't have the liberty to be able to chart a just and orderly transition, because on this issue also, we also have to manage the spillover effects from other transitions of other countries. So the challenges faced by emerging countries are much more, because we don't have the headway, and yet we have to do this transition in a much shorter period, and with a lot of the constraints that we have from fiscal coming up from the COVID, and to making sure that like what some of the speakers in the earlier session said, that then how do we drive our economy forward by looking at private investment, looking at supply side policies, and not just demand side policies. And so all this would have an implication as to how inflationary expectation, inflation, and how we conduct monetary policy. Like I said, in all this, it's very important for the central banks to be able to maintain its credibility, because we have seen in the past where the central bank's credibility is impacted, the chances of inflationary expectation being de-anchored is much higher.
Thank you, Shamsia. Ian?
Yes. So let me quickly make three observations. The first observation is what Francois talked about, this inherent uncertainty when you conduct these types of scenarios, and then of course bring these scenarios into macroeconomic domain, think through the issue of inflation, output consequences of climate-related shocks. Because even in the NGFS scenarios, they are using these multiple models to capture different aspects of transition and physical risks. You look at GDP impacts, for example, the impacts could be anywhere between 3% to 8% to 10%, depending on the scenario you are looking at. Francois showed it at the beginning of his presentation. By the way, I encourage all of you to get Francois' presentation and look at it. It's very short, but it has a number of thought-provoking ideas. So the second issue is, given this uncertainty, what can we say about level of inflation and whether it is going to be persistent or transitory? I think if we have learned nothing during the past 2 years, we learn one thing, even if we think whether it is high or low, transitory or permanent, we would like to be very careful about our observations with respect to future inflation. There's a possibility on the demand side as well as the supply side, climate shocks can translate into higher inflation. And that's something, of course, the type of challenge the central banks have to focus on. And there, I think my third point is how central banks need to adjust their monetary policy frameworks or the conduct of the monetary policy. Francois' point is, in some cases, the impact is around 1 percentage point higher inflation. So if you are targeting inflation around 2, you might have to consider it's going to be very difficult for you to reach that target, not over a short or medium term or the long term. So you might have to adjust your target, or you might have to think about whether you are going to be much more aggressive when you basically face these types of shocks. And there, I think we need to think about different scenarios. These scenarios can be country specific, but at the same time, we need to think about scenarios for different countries. Those scenarios could have different implications if you are an energy exporter versus if you are an energy importer. So I think the bottom line is that this is an area more work is needed to think through possible outcomes and possible policy responses. It's true, yes, these outcomes are quite wide, but at the same time, it's true that central banks have to be ready to respond to these shocks. One point, Ravi, about your parallel between China's entry into the global trading system and this climate transition. I think China's entry, to some extent, of course, a global shock, disinflationary shock, but the climate change, whether on the upside or the downside, could be a serious global shock that will require serious thinking how central banks would react to that type of global shock that could be rather persistent. So let me stop there.
Thank you, Ian. And listening to the panelists so far, there's also another set of issues that's coming up besides inflation, which is the need for transition finance. And Shamsia touched on it extensively. I can also say from the NGFS perspective, now that we've got 125 members, the majority are from emerging economies. Much of what I hear from them echoes what Shamsia just said and what Ian also said. And Machun as well earlier on, which is the transition challenges in the emerging economies are just so much sharper. So here I think the question is there a role for us as central banks and regulators to incentivize, to facilitate, to encourage, whatever adjective you use, the financial sector to engage more actively in transition finance? The reason I ask is this. 2 weeks ago, we had our International Advisory Panel meeting at the MAS. We had a very large gathering of global bank CEOs from Europe and America, and of course from Asia as well. And one of the things that the European bank CEOs consistently tell us is that we want to finance Asia's transition because we know the challenges here, but it is extremely difficult because we are under pressure from back home, sometimes from NGOs, sometimes even from policymakers, to exit from coal, to exit from anything that is above a certain carbon footprint. And if we did that, all that's going to happen is that transition is not going to take place. So you need a more intelligent approach to doing this without compromising what I just said at the start, which is the net zero by 2050. You can't compromise that because otherwise the planet is going to be in huge trouble. But we've got to find a way to get there by different approaches. So, Francois, you mentioned a disclosure and making it mandatory. Some of them have concerns that if they start disclosing in great detail the carbon footprint, looking at current footprints and not looking at transition trajectories, you could have counterproductive results. So that's one question for you. And for Ma Chun, I know China has been doing a lot of thinking on this subject because China faces some of these problems of transition. How do you look at the issues of disclosure and the correct incentives for financial institutions to engage in transition finance? Maybe Francois first.
Dear Ravi, as usual, your questions are very accurate and acute. Perhaps two remarks. First, on the question of the right transition and the need to finance, at least in the short run, still some fossil energies. I don't think the answer can be to stop disclosure. We live in open societies. So if we have to finance for a while, and in the spirit of a transition, still fossil energies, we should be able to say it, and banks should be able to say it. By the way, you mentioned this challenge for Asia. We have it in Europe in the short run due to the Ukraine crisis. And we are not especially happy that some countries have to go back to coal or oil, at least for some years, in order to substitute Russian gas. We have to define what I call a compatibility path. In the long run, the Ukraine crisis is an excellent incentive to accelerate energy and climate transition. But in the short run, there are some contradictions. So let us discuss about it and be clear about the transition and not to put the dust under the carpet, if you allow me. Second, it's about this question of how can we foster, we central banks, green finance. I am a bit cautious about the idea that we as central banks should finance directly green projects. There is this call sometime, but we are not development banks. We are central banks. Having said that, if I take again the European case, we have to develop the use of private capital and capital markets to green the economy. We have a wonderful project in Europe, and Christine Lagarde, who attends this conference, is a great promoter of this project, is Capital Markets Union. Believe me, Ravi, unfortunately, we were not able yet to convince politicians and public opinion that it's more than a technical and boring project. It's not. If we can mobilize private capitals in Europe, we have, like Asia, significant amounts of savings. It's our collective asset, but we should fund climate transition not only through public investments, because they are limited, but also through private capital and have a green capital market union. I think here we can be strong advocates and we can be very instrumental in promoting CMU.
Thank you. Thank you, Francois. As usual, you've taken the issue by the horn, not avoided it. I'll turn to Ma Chun now for his views on transition. And I think there's an important point that Francois made. It's not the role of central banks to be extending financing, but we can play a role to bring together multilateral development banks and the financial sector. So here I'd like to ask if Ian can address that. I'm just told Ma Chun has left because he's got some other urgent matter to attend to. So I'm going to pose that question also to Ian. Transition finance, what are the perspectives from the World Bank? And how do you think multilateral development banks can work with the financial sector and possibly with central banks to make sure that the private capital that needs to flow into this actually does? Because there's enough private capital, as Francois says.
Yeah, so thank you, Ravi. Francois' points are well taken. And I think Francois will be the first one to say central banks have an important role and a catalytic role to play when we think about combating climate change, when we think about the kind of the finding ways or facilitating the financing, providing a platform for transition plans as well as sustainability disclosures if it is the regulatory entity. But at the same time, we should also acknowledge central banks' role are complementary. The governments have the bigger role when it comes to taking on the climate change and pushing the envelope further. Central banks can do certain things within their own mandates, and they should do so. Now, with respect to multilateral development banks, they have a critical role to play in working with central banks and regulators to help promote basically the collective efforts to deal with climate change. There are different ways how these multilateral development banks can help in terms of analytical work, advisory services, operations, their convening power, last but not the least, lending. So that's quite different than central banks. Multilateral development banks, basically, they put money on the table to push the kind of the climate change related projects. I'm going to talk about the World Bank a little bit. I don't want it to be a kind of a promotional the kind of the lecture, but what we are doing, I think, is useful to explain how the other MDGs approaching. So we are supporting more than 60 countries to help their financial systems to basically become more agile in terms of supporting the transition to a greener economy. Here, it is very important. These countries, the central banks, the regulatory agencies, have the tools to assess and manage the impact of climate risks in the financial sector, okay? So I would like to make sure we are keeping the boundary very clear. How we are supporting our member countries, emerging developing economies, through several diagnostic tools and the policy tools we have. We have a wide range of tools when it comes to vulnerability analysis of their economies and financial sectors. We have programs in the Philippines, South Africa, Morocco, Vietnam, and we are trying to basically help countries to integrate climate risks into regulatory frameworks and supervisory approaches. We do that in Morocco and Colombia. The climate risks and opportunity assessments are critical. These are, part of financial stability assessment programs, the FSAPs. We do it with the IMF. We did it in the case of Mexico, Bangladesh, South Africa. These assessments provide the type of advice regulators and central banks need on supervisory approaches on climate risks. Now, one important role the IFIs and MDGs can play by contributing to developing and aligning international standards. And there, of course, we are working with the FSB climate roadmap. We are working with the NGFS. And the data issue is a big issue. These entities are, of course, cross-country entities. They play a significant role in terms of collecting this data, making them uniform, and then presenting in a form that's useful. For those of you who do not know, we have a climate change knowledge portal, which is very useful when you think about the historical and future climate vulnerabilities and impacts. And I think the kind of the broader issue with respect to financing, and we are just out of COP27, there was a significant discussion on this issue, and I should briefly mention that. There is a tension between emerging market developing countries on the one side, advanced economies on the other side. There is need to undertake measures on the ground to get ahead of the problems associated with climate change. Some of these problems relate to adaptation. Some of these problems relate to mitigation. Some of these problems are about physical risks. Some of these problems are related to transitional risks. But we need to be honest about the essence of the challenge we face, and that is financing. For many emerging market developing economies, climate risks and the consequences of the materialization of these risks much, much larger than for advanced economies. And these economies do not have the capacity, analytical capacity, operational capacity, but most importantly, financial capacity to address these challenges. The World Bank is the #1 multilateral development bank when it comes to climate-related financing. Last year, we basically financed around $31 billion. But Ravi, you mentioned a number, $8 trillion investment needs. So this is just a drop in the bucket. So there is a serious need on the part of global community to address this challenge, and that will start and end with financing. Otherwise, of course, central banks can play certain roles I can discuss in the context of regulation, in the context of pushing, disclosure standards, in the context of providing broader scenarios with the kind of the international organizations as well. But addressing the financing challenge will require huge Herculean effort on the part of global community if we are going to take this challenge head on in the context of emerging market developing economies. But let me stop there.
Sure. Yeah. If I can add, I think you also raised a very important point, because for emerging countries, it's not just access to transitional financing, that access to climate mitigation and climate adaptation financing is equally important. And echoing what Cecilia has said, if I were to get a Christmas wish, is for even middle-income countries, because what we see in the global landscape is there's often help given to the low-income countries or the least developing countries, but countries in the middle-income countries, especially the upper middle income or even the middle income, do not get as much access to IFIs, either financing or know-how. And I think we need to figure out as to how, we also, those that are in this middle income, what we call middle income trap, countries in this middle income also equally have access to the know-how and some of this financing at the concessionary rates, because COVID-19 has impacted all countries, be it the rich, the advanced, the middle-income countries, or the lower, the LICs. But all of us require access to the know-how and also concessionary financing, especially when it comes to climate adaptation and climate mitigation on top of transitioning financing. So how best, like what you said, so I really am encouraged with what World Bank is looking into, but our wish list is for you to expand the possible beneficiaries to some of your work to the middle income countries also.
Thank you, Shamsia. That is not only Shamsia's Christmas wish, it must be all our Christmas wish for many more Christmases to come, that we get transition finance and adaptation and resilience finance in large measure. We've got about 12 minutes left, and I do want to open this up to the audience to pose your questions to any of the panelists, but keep it succinct and brief. Yes, Adrian.
Thank you, Ravi, and congratulations, everyone. And Francois, you're coming through very clear. Well done. I just wanted to ask, and I suppose to the World Bank, in the sense, what are better ways of leveraging your position, your capital, because you're not going to be able to direct invest or just co-invest with everyone. Is there work going on, first loss recipient, the global balance sheet operating in that place to better leverage, enable private money to come in? and we could dovetail it into Francois' desire for consistent long-term rules that could be used as indicators for or guidelines for first loss behaviour. Is there any work at all going on?
So, okay, thank you, Adrian. Now, just to provide a little bit of context, because there's obviously an issue here. At the last IMF World Bank meetings, there was a desire on the part of shareholders to look into the World Bank's ability, the first World Bank and then the other multilateral development banks, to be more active in the climate space. One of the kind of the desires of the shareholders was to leverage the World Bank's resources more effectively. Just to address this issue, it's not just low-income countries. Increasingly, middle-income countries need financing to basically cope with climate-related risks. What we are doing now, Adrian, we are preparing multiple papers to have a roadmap, which we will soon share with our board, and you will get it through your executive director at the bank. Looking at the operational implications of possible changes, financial implications of possible changes, and of course, how these affect our overall approach when it comes to advisory and policy work we are doing. There is no question, as Ravi mentioned at the beginning, we have to do more when it comes to climate change, given the threat we have. And we feel that, I must say, more than other institutions. Let me give you just one example. And I think Adrian knows these issues very well. We have give and take 40 small states in the world, the population less than 1.5 million. Some of them are Pacific islands. Some of them are Caribbean islands. These are, most small island states. When you look at the impact of the pandemic, the negative impact, it was felt the most on these small state economies, especially island states. When it comes to climate, the largest impact is felt on these small states. So in the forthcoming Global Economic Prospects report, we assess this damage actually in general. But the bottom line is that these very small countries, and their numbers not small, as I said, give and take around 40, desperately need help to find ways to cope with the consequences of climate change. Okay? And those consequences are simply life-threatening. In some cases, because of the increase in the level of sea, some of the land disappears in these islands. So the leveraging of our financial resources is one way to go. But there, as much as we would like to optimize it, the room we have is small. That's why it is so critical, global community, to provide larger resources directly to these developing economies or through the multilateral development banks. And we are looking forward to having a robust discussion on this issue, but we just need to acknowledge the kind of the big problem here. And that starts with financing and ends with financing. We can push, as Ravi mentioned, private sector to come to the table. But of course, the private sector has its own priorities. In the context of the bank, we have a wide range of instruments. Some of these are outright financial instruments like green bonds. And some of them, we are directly de-risking projects on the ground because we have, investment project financing programs. In some cases, our development project financing directly targets climate-related financial instruments as well as projects. So there is quite a work, large amount of work underway, but the needs, demands from the membership much, much larger. That's why I talked about this need for the global community to be much more active.
Thank you.
May I, Ravi?
Yes, yes, Francois.
No, add one very simple conviction to Adrian's point. I think we won't miss resources at global level. We won't lack resources. Where we are at risk is the absence of coordination, and it's a distribution problem. And let me briefly explain. We have been observing for 2 decades now the savings glut. We have been observing the diminution of R star. So I don't know whether climate change is the answer to these challenges we have been observing, but at least we had at global level sufficient savings and resources. That said, I don't underestimate the distribution and coordination problem we have. It's a very difficult political discussion. I hope COP 27 or 28 now will be useful on that. You remember that COP 21 in Paris said very clearly that we had to fund the low-income economies by $100 billion yearly. We are not yet there. And there is a very difficult political question. What is a middle-income country exactly? Which middle-income country should receive? Which middle-income countries could contribute? But it's not my job today to settle the issue.
Thank you, Francois. I'll just scan the room for if there are any. Yes, Cecilia, please. And maybe that will be the last question before we close off the panel.
Thank you. A question for you, Ravi. So you mentioned, I think you mentioned European banks had come to the MAS saying that basically they couldn't help financing climate change in Asia because they were stuck with having to reduce credit exposures in fossil in Europe first. That is what I heard. So
no, not quite. Yeah.
Okay, but because my worry, the way I listened to it, was that are we getting exactly what Francois pointed, that we need to coordinate and we must avoid a situation where different parts of the financial industry sort of play us out against one another.
Yeah.
So it would be really interesting to hear more about this interaction and what you said and what you think about these worries.
Yeah. So let me explain. It relates to transition finance. And in Asia, if you look at Asia accounts for 50% of global greenhouse gas emissions. Of that, if you take that on a base of 100, 18% of Asia's greenhouse gas emissions come from coal-fired power plants, right? And Asia is building more coal plants because if you take just Southeast Asia, 45 million people do not have access to electricity. If you take South Asia, it's well over 100 million. And even in countries like India and China, which have been massively increasing renewable energy investments, very impressively, they are still having to build coal plants because of the energy needs of the population. The three things that we all take for granted, electricity, clean drinking water, and modern sanitation, is lacking in many parts of Asia. So, long story short, they are building the coal-fired power plants. We are examining the possibility for early exit from coal-fired power plants, meaning invest in high-emitting sectors and impose a transition plan so that they decarbonize over 5, 10, or 15 years, and they switch to cleaner fossil fuels and ultimately to renewables. Now, in order to do that, you need to stay invested. What many of the global banks are saying is that they see the necessity for doing this because they are in Asia, they understand the situation, but they face pressure from some of their stakeholders and NGOs who want an immediate cessation of investments in coal or high-emitting sectors. Now, if they were to do that, it will make their balance sheets look good, but you're not solving the world's problem because somebody else is going to finance it, and they're going to finance it in a dirty way. Whereas I think if we got the advanced economy banks to finance them, they can impose good transition plans. So we're trying to build a consensus around it with the Asian Development Bank, GFANZ, and the NJFS to try to build this consensus. So basically what we're saying is we want to provide them air cover. They're asking us, regulators and central banks, can you bless this? Well, we can't bless private sector lending, but we can actually, through our actions and supervision of financial institutions' transition plans, make a pronouncement that this transition plan is going to lead to decarbonization. It is on a Paris-aligned pathway to net zero. So even if in the short term the emissions profile goes up, it is acceptable. I think they're looking for legitimacy because of the pressures from Europe. So I hope that clarifies. Yeah? Thanks. Yes, Augustine.
The very last question. I mean, we have discussed a lot about finance, about information, but the other thing that is really essential is projects. I mean, here in the BIS to support the central banks in their investment in international reserves, we have created these green funds. And one problem we face in Asia is that there is no sufficient emission of bonds that could be investable. And in a way, it echoes the opinion that was expressed by Francois a few minutes ago, that it's not necessarily a problem of resources, but it's more how to use those resources. What can you tell us about projects? I mean, is there sufficient projects? Why are not they coming on board more agile? Why don't we see more about this in a more patent way, so that, you know, this sense of progress is there? I mean, I have a feel, we all, in all these meetings, we feel we're pushing for financing, but at the end of the day, my sense is where is the money going to? Yep. So, I mean, I don't know, what can you comment about that?
Okay, I'll attempt that, but maybe Ian can also, maybe Ian, why don't you go first? Yeah.
Thank you. So let me try to address this point Francois made. Don't we have the resources? The problem is in the coordination. So the resources, I mean, it depends how you look at it. Here we are telling the international financial institutions to do more. For these institutions to do more, I have here my colleagues from the IMF and from the World Bank. Global community has to provide those resources. And then in the case of World Bank, we can leverage it. So resources can be there, but in many cases, fiscal space is diminished, exhausted. So governments are very careful to allocate and to deliver their promises in the context of COP21 they made to developing countries. Yes, coordination is a problem in the context of climate change, and we should take that very seriously. And this is very similar to this food crisis issue, the kind of the central issue G20 tried to tackle with. Is there a problem about the lack of food at the global level? No. When you look at the stock to, you know, the use ratios, ample amount of grains out there, ample amount of staple products out there, but still we have many countries, especially in Africa, South Asia, having all types of food insecurity challenges. You might call it the coordination problem, or you might call it, you know, global communities' unwillingness to provide the necessary support. Now, in the context of projects, Agustin, your point is very well taken. There are projects, not enough number of projects, because when private sector looks at the kind of the climate change problem and the experience they have seen over the past 2 years, there are important lessons. We try to tell, you know, the kind of the polluting sources of energy producers not to invest. And now we are doing exactly the opposite. We are telling them to invest because we realize that this transition is very difficult. There are significant uncertainties associated with that. That's why in Asia you have a lot of still coal plants coming in line. I think the big issue is somebody has to de-risk the projects and give the private sector the type of, the insurance that there is certain return when they put their money in, climate-friendly sources of energy. Because the big issue is energy transition, and then the big issue is transition of commodity markets. So I think we know the problems. We have a good idea how to solve them. Maybe we are not good at coordinating. Maybe we are not willing enough to do the right thing.
Thank you. And I think we've just run out of time. I see 000 in front of me, Setaboot. I will just take a minute or two to shamelessly draw from the wisdom of the panelists who have provided many useful insights. I think first point, the climate change and the transition has huge macroeconomic impacts potentially. We do not know all the details of the direction, but we know it can be significant, both for output and inflation. And as central banks, that is part of our core business, to understand those implications and assess what the implications for monetary policy is. That's one. Second, it has an impact on the financial sector. Those of us who are regulators, we have a responsibility to ensure financial stability and to make sure that the environmental risks associated with climate change and the transition are well managed. And that means stress tests, scenarios, and environmental risk management guidelines, and so on. Third, there is a role we can play in disclosure, in requiring financial institutions to disclose not only their carbon footprints, but their sustainability efforts and their transition plans, and how they intend to stay safe and build resilience in their balance sheets. And that will also instill market discipline. And through them, we can probably influence what goes on in the real economy. I think these three things are obvious things that central banks and regulators can do. The fourth is at the edge of our mandate, where we ask ourselves what can we do to lean in or to nudge or facilitate the green financing that is necessary. And here I think the central banks and treasuries of the world have a role in the multilateral development banks. We are major shareholders. And if we put together our plans and our wisdom, we can nudge multilateral development banks to maximize the use of private capital. I fully agree with Francois. There is no lack of money to solve this problem. But unfortunately, the money is sitting in three different places which are uncoordinated. One part of the money is sitting in multilateral development banks, which we need to maximize to draw in private capital. Today, the ratio is 1 to 1. $1 of MDB money draws in $1 of private capital. We need to raise that 5 times or 10 times. That means major reform. And that means the shareholders, that means treasuries, central banks, and governments. The other pocket is banks. Now, banks are willing to lend, but they have to watch their risks. And I think for good reason. And many of the projects, Augustine, in this part of the world are below bankability. This is where public capital needs to come in to tip them over so that the banks can lend with a decent return and minimize loss. And then the third pocket is institutional funds, capital markets, and they are huge. But they're not going to be investing in a solar plant or any of those lumpy projects. These investments from the bank's balance sheets, and I would also say from the multilateral development banks, need to be taken off, securitized, and sold to private institutional investors. Because that's where most of the money is. That's the largest bucket. If we can get this coordination, we look to the efforts of people like Francois, Christine, and others to move this, I think we can solve this problem. And it's a problem that can be solved to avoid what we call the tragedy of the commons, because we all think it's somebody else's problem, it's not my job. But none of us have the instruments to solve this on our own. But if we pool ourselves together, it can be solved. So maybe with that, I'll end off this session. Thank you very much for your attention. Thank you.
Thank you very much, all the speakers. Ladies and gentlemen, we have come to the end of today's conference. It has been a great pleasure and wonderful experience in taking you all through the journey of central banking amidst shifting ground. On behalf of the Bank of Thailand and the Bank for International Settlements, we would like to express our sincere appreciation to all of you for your participation. Please enjoy the rest of your evening and have a safe trip back. Ladies and gentlemen, for all delegates and speakers, next will be the post-meeting activities. You will experience many interesting activities, ranging from visiting Bang Khun Prom Palace, which is considered one of the most beautiful Western-style palaces in Thailand, to an art exhibition that showcases the paintings and art crafts of artists with special needs, and traditional Thai flower art that shows the creativity and intricacy of making